So we'll get right into it. There's plenty to talk about. Usual, overview, board meetings, update on the new fund and executive session. Um, the overview, we've reorganized this just a little bit um, around each fund, trying to get through it more quickly. So Fund 3, Lumira DX, or we're going to share a little bit more information. It's probably been a kind of a mystery company to everybody. And they really have been a mystery company to the world. I mean, they've been in stealth mode for 6 years, and now they're kind of coming out. I had a really good update call just the other day with the CEO, and it's pretty incredible what's going on there. So looking forward to talking about that. They are in the market with their COVID tests, both here in the U.S. 90% of what they're doing in the U.S. is actually CVS, which is one of the investors in the company. And then they're in Europe and Africa and Asia. So we'll get to that. The 2020 forecast, Partners Capital, increased a lot. This is all primarily due to Lumira, which just closed another internal equity round. Our Partners Capital jumped by quite a bit based on a discounted value of the last round price, which we'll talk about more in a bit. And we're now looking at a very plausible return of all committed capital and more. Now that sounds like I'm just about to contradict myself, because at the last report, we actually had a life of funds report that was a little bit up over return of capital. Now we're sort of down to just return of capital, but the only reason for that is that this round that just closed, we didn't change the company's forecast, although we probably should. But as of right now, it looks like, there's a pretty good chance the investment will return all of our capital and essentially all, if not all, prioritized payments to SBA. We'll get into those numbers later. So that's the Fund 3 update. Fund 4, it's still really all about Invoke Solutions, our one remaining company. If you remember, they do they basically work. A lot of their work is for movie production theater, ABC, Disney, and the rest for new releases of theater content, and the production theater has been shut down. So they really got hurt for a couple of second and third quarter. Things are starting to come out now and looking much better for the company in terms of doing assessment of new releases. The financial results were down, partly just because of the results, the operating results of Invoke. So in 2020, in 2021, we're still very focused on an exit and a final liquidity event for the fund. Interestingly, despite the fact that the company is having a tough year, but coming out of it, our current forecast for the exit is improved a little bit, primarily because it doesn't now look like we'll have to put any more money in, although we still could, but that improved the multiple and the IRR. Fund 5, some really good news here. A couple of big events probably drove a lot of this. Ninth Decimal, the sale of Ninth Decimal, which was a company that was struggling and quite illiquid. We found a really good home for it, merged into this company InMarket. This is a big event not only because the combined company is a $100 million profitable, well-capitalized growing company, but also the way the deal was structured. We have a very senior position in how any liquidation would happen. So it was a really good event for us. I have to thank Mark for that. I kind of structured the deal, but then went on vacation and Mark closed it. And it was a pretty difficult closing. So thanks to Mark for getting that done in early September. The portfolio is doing quite well in the COVID environment. And in particular, Wasabi is now looking like a unicorn investment. We'll talk about that. The forecast for 2020 and 2021, the Partners Capital actually declined a little bit. All of that happened in the first quarter, and we've sort of been recovering. And that was writing down ninth decimal early on, and then we sort of been clawing our way back. We may actually end up doing better than that decline, but Partners Capital will decline a bit. Oddly, at a time when we're going to have almost $9 million of net income and realized capital gains. And then we've been talking to SBA about a tax distribution, so hopefully we get that organized early next year. The great news here, our last report, we were looking at a 2.33x return and 14%. We've now increased our forecast based on the 90 in-market merger and the Wasabi forecast. We should be better than 3x. And I bite my tongue when I say this, but we've been trying to hold down the Wasabi numbers. I think it could end up doing even better. And then Fund 6, great progress here. We actually just had an update call with Stifel this morning. Stifel has approved a $20 million LP commitment to our sixth fund. We have a term sheet that's being negotiated for them to acquire North Atlantic. So it's called an acqui-hire. They're actually acquiring our brand, our team, and the Fund 6 opportunity. And they're going to engage their resources in not only helping us raise the fund, but with all of the resources they have to help us execute. We have a green light letter, which runs out in March, which is a little problematic. Our relationship there is good. It's likely to get much better when we send them a $27 million check for Fund 3 early sometime next year. But we do have to discuss the green light letter, either an extension or a reapplication with Stifel on the application. Still targeting a close, hopefully around second quarter with an extension of the green light letter. First close today is targeted at 16 million, with some indications they might relax that in light of COVID and everything else. So just a little bit on Stifel. For those of you who don't know it, we've done Stifel. Stifel was very helpful. They were part of our IPO for Tango. They're also then part of getting Tango sold privately after it was public. And Mark, they helped out with a couple of other companies, I think, didn't they?
They were the banker on Vivissimo. They were a banker on Synacor. I think I can't remember if there was one other as well, but there were several where they were quite involved.
Yeah, so they know us, we know them. Just so a little bit of information on them. Stifel has been acquiring companies over the past, I go back to 2005 on this slide. Lots of names that many of you know, like Mason, UBS, Thomas Weisel Partners, KBW, Keith Bruyette and Woods, which very well-known name in the banking industry, Barclays, Eaton Ziegler, and next year we hope that we're North Atlantic is the top of the most right-hand column. So we're joining an aggressive, sophisticated bank and investment bank. We would be housed in the investment bank and we'd report directly to the head of the investment bank, Victor Nicey. Just a little bit more background on Stifel. I mean, their strategy fits really, really well with ours. They're very active. As I said, we know them through transactions we've done with them, but they're very active in the sort of middle market areas, and particularly in technology where we play. They've got great resources in terms of research. They're very diversified, lots of different areas, certainly technology, business services, diversified finance, lots of areas where we're interested. And they're very highly rated, award-winning research, being number 5 here in the Starmine Award and Analyst Rewards with the likes of JP Morgan, B of A, Wells, Goldman Sachs, UBS. They're right up in there. So they're a really good resource for us. So yeah, we're really excited about that and look forward to talking some more about it a little bit later. Any questions before we move on? Okay, so Fund 3, the minutes were, see if I can do this. There we go. These were distributed. If you didn't have a chance to read them, you can speed read it right now, but I'd entertain a motion to approve the May 20th advisory.
So moved.
Okay, thank
Second.
you, Carl. Thank you. All in favor?
Aye.
Aye.
Thank you. Okay, we're going to first talk about the portfolio. Just before I turn this over to Mark, we tried to make this a little bit more informative and a little bit more interesting. So what you're going to see on most of these portfolio company reviews is a little more information on the screen. So please, if you see things you have questions about, go ahead and ask them. But we hope this is a little bit more informative. And then for most of the companies, we'll actually have some other KPIs, some details that we actually look at from the companies in their monthly reports to us to sort of give you, another layer down, kind of a detail of how some of these companies are doing. But first, Blue Ridge.
First, Blue Ridge, where we don't have a second page, because this is one where we're not expecting a lot in addition from Blue Ridge. You'll recall several years ago, or now 3 or 4 years ago, that they sold some of their assets that enabled us to have a distribution that paid off the Fund 3 loan to Bangor Savings. The company has started to see improved performance from a revenue perspective than they've had, but it is from a much decreased base from where they've been. And they're not hitting their plan, and they're burning a lot. Their pipeline is growing. It actually looks like they're going to have quite a good Q4 as well. So there may be some good activity going on there, and for us that's good, and that we hope it'll lead to an exit next year in one form or another. The company is out looking to raise capital or be acquired right now, and in either scenario, we've told management would like to to either sell our shares to someone who's investing in the company, or obviously exit if there is an exit. So and it's ideally kind of timing it around the same time as the Lumira exit.
And Mark, how much are they looking to raise?
They're looking to raise probably about 5 to 8 million.
Sorry, I put myself on mute again. And what are they going to use the money for?
It's for sales and marketing and some operations. So they're seeing increased interest in their products, and it's where the activity is coming from right now for industrial security, industrial IoT security. And they just this week have signed a contract with Honeywell, and they've got some with Schneider and some others, and have a building pipeline in that area. But it's a really small team right now, and so they'd like some additional sales and marketing and operations staff to continue to grow that line of business. The company has enough capital, they say, with the existing funds and with a little bit of committed capital from some of the management team, to fund the business through 2021 without raising capital, but the additional capital should further accelerate the growth.
Mark, do you want to just update on Blue Planet Works too?
Sure. There's not a huge update. So if you recall, Blue Ridge sold again the assets to this company, Blue Planet Works, in Japan. That has not taken off the way that was originally anticipated, but about a year ago now, maybe a little less than a year ago, the Blue Planet Works did a recapitalization. It had been funded almost exclusively by some large Japanese companies, and a sort of US and Japanese based venture firm came in and invested earlier in the year, has put in some additional money, has stabilized things quite a bit. It actually seems to be a good thing for that business, but their revenue is still quite small. I believe they're expecting to do around 8 or 10 million of revenue. Blue Ridge, after the recapitalization, owns about, I think it's around 8% of Blue Planet Works. They still have high hopes for that business, but at the moment it's not as big of an asset as it once looked like it was. It may still take off, but it actually feels a lot better from a management and control perspective than it did a year ago. But the revenue hasn't caught up to expectations.
I want to remind everybody that for many years, I've given up on this company and was going to Mark's
Good
office
reason.
and say, we got to just, let's just dump it. Let's give our LPs the benefit of a write-off. And then the Blue Planet Works happened. We got enough money to pay off the $4 million loan from Bangor Savings Bank, which saved the fund. So we've actually done well by this company, even though they've struggled. But that sale of the intellectual property to Blue Planet Works was a really big and important event for us. Thanks for Mark for pushing back on my desire to not see the Blue Ridge Networks logo ever again.
With good reason. It gets tiring after a while, but
yeah,
free option.
They did well by us. So.
Yep.
Any other questions on Blue Ridge? We did mark it down a little bit, I think, this quarter. But,
yep.
So I guess the big story in this fund is now all about this company, Lumira. It's almost hard to know where to start. Everybody, I think, remembers that this really grew out of a failed investment in FitLinks. I mean, FitLinks, we were trying to take FitLinks public. Remember, FitLinks was a sort of a fitness tracking business. We tried to sell it at the time that Fitbit and Apple and everybody else was coming out with devices, and it was just really bad timing. But we had some interesting intellectual assets. We ended up selling those to this company, Lumira. And those intellectual assets have to do with devices communicating between each other. And that intellectual property is actually very important in the success of Lumira DX. But Lumira DX is basically a point of care diagnostic system that's designed to be deployed globally at the point of care. It was charging along towards a launch this year with, I think, 4 or 5 tests on its platform. When COVID hit, all of a sudden, the company shifted totally to focus on COVID. And they now have FDA approval for their antigen test. Should have an antibody test approved possibly this week. Their test actually exceeds the performance of the others. Becton Dickinson, Abbott, and Quidel, I think, is the other one. Not by a lot, but it is the best performing test in the marketplace. As I said earlier, most of the distribution in this country, the company's in Stirling, Scotland, most of the assets. CVS is an investor, so they're already being distributed. 90% of their business is through CVS, although I found out, it was yesterday before yesterday with talking to the CEO that they just opened up Johns Hopkins. And but they're basically, they're resisting taking on any new customers because they have all the business they can get just because of the explosiveness of the testing market for COVID. They actually got a call from the 2 most senior new people in the Biden administration for healthcare, saying, what can we do to help the administration in terms of testing? So that may open up just for political reasons, but they're doing an awful lot in the UK. They're actually negotiating a £1 billion contract with the National Health Service. I think I've mentioned in the past that Gates Foundation is an investor, and Bill Gates and his team are very focused on sub-Saharan African healthcare. There are 25 countries in sub-Saharan African. I have a hard time saying that. Africa. This is going to be the sort of the diagnostic system that a consortium of those 25 countries is adopting, funded by the Gates Foundation. So this is a big deal. It's global. They are, they've had some revenue in the past, as you can see in that upper right-hand box. A lot of that has been a contract they've had with the National Health Service, basically trying to manage on a project for the city of Manchester, England, improvements in how healthcare is delivered under the National Healthcare National Health Service. But the real story here is about the diagnostic kit. You can see in the third quarter, things began to tick up with revenue there of about $12.5 million, just to give you a sense for how fast things are happening. October was, so that was 12.5 for 3 months. October alone was 18 million. November alone was 26 million. These are $1 million of revenue. December will probably be between 50 and 70, so call it $60 million. So the fourth quarter will be $100 million of revenue, and probably break even in terms of bottom line in December, or at least close to it. And then the first quarter, it gets harder and harder to forecast the numbers, but the first quarter of 2021 is looking like $250 million. That's $1 billion run rate, basically, 4 or 5 months from now. And that business has already been booked. It's not a matter of having to go sell. It's just a matter of ramping up. And oddly, I asked the CEO, I said, how do you go from, a run rate of $6 million a quarter to $250 million a quarter without having serious problems? He said, well, basically we have about 6 or 7 customers. It's the Gates Foundation, it's National Health Service. They have distribution in Italy and Spain and the US. So but it's pretty extraordinary and explosive growth.
David, quick question if I could.
Yeah.
What portion of that 100 and then 250 is COVID specific versus other diagnostic? And what is their post-COVID expectations? And again, that's a bit euphemistic at the moment, but nonetheless.
Yeah, that's a great question. And that, so the CEO has been really good to me. We've built up a nice relationship. I'm not on the board, but he invited me to attend a board meeting in October and shared some numbers. This was the low forecast. And this sort of gets to it, is that the expectation is that COVID testing is a shot in the pan. And that, so 2021, $2 billion of revenue and earning over $1 billion is the low end. That's mostly COVID. And then after you get, once you get to 2022 and beyond, that's non-COVID. They plan to have as many as 100 different tests on this platform when it matures out in the mid-20s. So, but right now it's almost all COVID. They really shifted all of their resources to COVID, and the beauty for the company is that, and you hate to talk in those terms in a tragedy like this, but this is really forcing into the marketplace their devices at a much higher rate than ever would have happened before, which means when they do launch their other tests, they already have the infrastructure out there. People have the devices, they're used to using them, they understand how they operate, they understand how the information is uploaded on FitLink's technology to central databases. But they do expect that COVID will go away. And on the low side, it may or may not. It may linger, but this was their low end forecast. I almost hate to tell you what the high end. They're talking about $10 billion next year. That's possible, actually. I'd say it's something that is, the scenario is there for that to happen, but we've chosen to use their low end scenario. And what I wanted to do here on the bottom of this slide is to show how that kind of translates into value for North Atlantic. We did some very rough comps, and in the more mature companies like Becton Dickinson, Abbott, and the rest, the sort of average comp is like 7 times revenue and 25 times profits for valuations. Those kind of, you can do the math. If you take 2022, say it's $1.5 million revenue year, and multiply that times 7, you're up into the $10+ billion valuation range next year, and that would, that's kind of the range for an IPO, which might happen in 2021. And similarly, the metrics work on a multiple of earnings. So, we're now forecasting that we'll get our capital back, 100% of our capital back, and essentially all of the prioritized payments back to SBA. And then at a break point of about an $8 billion market cap, all of the profits, except for what we have to share with SBA, because there's profit sharing in the old participating securities program, but the bulk of the profits go to our partners. So we have a shot at, for a fund that was struggling to figure out how to pay back any of its private contributed capital, we have a shot. Maybe it's a long shot, but we've got a shot at a 2x. But we're not forecasting that at this point. Does that help, Bruce? Okay. So FitLinks, the little remnant is Tyler's doing a great job of sort of winding that down. We'll probably get a little better than $250,000 cash payment here before the end of the year, and put that entity totally to bed. I guess the other just important thing to mention in terms of the IPO has been actually approved by the SEC. Ron, the CEO, said the problem is things are happening so fast that updating the offering, the information in the offering memorandum is hard to do because things are changing almost weekly. The company does not have to go public. It has all of the capital it needs now to operate. So the IPO would be essentially for investor liquidity. The two other options for investor liquidity next year, as I talked to Ron about it, were the company continues to talk to Danaher and Roche and people like that who want to invest in the company. You may remember Danaher and Thermo Fisher are already investors in the company. Roche is not, but Roche has been sniffing around the company for years. Ron has offered this, only Ron can do this. Ron has offered Roche an opportunity to buy 10% of the company for $800 million. That's an $8 billion valuation. That cash would be used, because it's not needed for operations, it would be used for investor liquidity. So there's the IPO option, there's doing a strategic investment like that. And then thirdly, the company will be generating so much cash that he said likely just to have a buyback program for investors that, that want to buy back because they'll be generating so much cash. So pretty encouraging there in terms of opportunities for liquidity. And you can see the earnings, will start in earnest in the next quarter and be pretty significant. And yeah, so any other questions? I think I'm going to turn this over to Tyler to talk a little bit more about the numbers. But at this point in time, anything can happen in this world. But this is pretty exciting, and it's a feel-good company for us. I mean, this company is actually doing some pretty important work around the globe, and little North Atlantic and little FitLinks are actually a pretty important part of it. If there are no other questions, Tyler, I'll let you take it from here. I'll run the slides.
Okay. So in the third quarter, the changing portfolio company values increased from 13.4 million to 21.5 million. Much of the appreciation was a result of the Lumira DX write-up to the new round that David mentioned. So to break down the 8.1 million increase a little further, there was a small write-down on Blue Ridge of 45.6 thousand. This was mostly related to their financial, or it was all related to their financial performance. Their revenue for the quarter stayed pretty flat, but the cash balance at Blue Ridge decreased, which drove down the equity value. For Lumira, the company raised the convertible note in early Q4 that had a floor conversion price of $4 billion. The new series does have an accruing dividend, which our shares don't. So they're a little more attractive than ours. So we took a 20% discount and priced our shares based on a $3.2 billion valuation, which was up from, I believe it was 1.8 at the last, the Q2 valuation, but the new round did cause for some dilution.
And I think what Tyler just said is important. I mean, a 3.2 billion valuation is way below what is contemplated in an IPO or a strategic transaction. So it's on our books now for, it's a really nice increase. I think the increase for the whole year was up over $15 million because we had a bump in the first quarter as well, but still well below the likely transaction value for the company.
So now looking at the 2020 financial forecast, which has actual results in for the first 3 quarters. So looking at the Q3 actual results, we had a very small net total investment income of $100, which is just our idle interest at the bank. Very small expenses for the quarter of $800 for an ordinary loss of $700. And the change in net change in the value of Lumira increased by $8 million. So the total change in partners' capital was an increase in $8.1 million. Right below that, the September 30 balance sheet, total investments increased to 21.5. We still have 162,000 of cash on the balance sheet. The only liability on the fund's balance sheet is the 3.4 million of accrued management fees, and total private partners capital increased to 18.2 million. And then in the last column, we have our forecast for the entire year. So we're forecasting small interest income for the year of $900, 50,000 of total expenses for the year, which is audit, tax, legal, our PEF phone services, expenses related to the participating securities project. And so with those expenses, it brings our net ordinary loss to 49,800. We're expecting a small realized gain of 200,000. This is related to the FitLinks shares that are going to be the FitLinks distribution at the end of the year that David mentioned. That company has around 550,000 left in cash, and we're going to do final distributions this month, which we own about 52% of the remaining value. And then we had a write-up on the year of 15.1 million, the 8 million this quarter, and 7.2 in the first quarter. That's basically all related to Lumira. So the change in partners capital is 15.3. The balance sheet looks quite a bit different than the end of last year due to the big write-ups. So total investments increased by 15.1 million. Our cash balance increased due to the FitLinks shares that will liquidate this month. And so we are forecasting to end the year with 18.1 of private partners capital at the end of the year.
Any questions before we go to the forecast for next year? Okay.
All right, so 2021 now. The major events taking place in 2021, as David mentioned earlier, is liquidation of our Lumira investment. So we are forecasting in Q3 to receive 51 million to North Atlantic from Lumira DX. And then in the fourth quarter, we are forecasting the liquidation of Blue Ridge, which we're forecasting to be sold for about the balance we have on the books right now, which is around $400,000. So for the whole year, we have the small total investment income that's just related to idle interest, around 42,000 of expenses for a net loss of 42,000, but we have roughly 30 million of realized gains and change in investments So total partners capital will increase by 30.7 million. The big thing is if both of our remaining companies liquidate, then the fund may be able to wind down in the fourth quarter of next year. So we're showing no assets on the balance sheet at the end of the year. And we are showing that we will have made 22.6 million in distributions to the LPs in GP, which is the remaining amount of the contributed capital. So the LPs will be made whole. And then the prioritized payments to the SBA of 26.3 million is the next item in the waterfall.
Any questions for Tyler? Okay. And this, we've decided to put up lots of numbers on, I hope you don't mind, on the screen, much more detail on the two quarterly financial reports that Tyler just went through, just so that we thought it would be helpful to have more context for as we look at quarterly numbers. And this is obviously our life of funds forecast. We usually have this in the appendix. We thought we'd bring it forward because there's a lot of really good information in here. This one is pretty simple. This basically explains in the 2021 column what Tyler just talked about is going to happen and shows how it plays out in terms of returns to RLPs, returns to SBA, and then in yellow on the top, it's sort of the total portfolio gross return. This is a standard format we have for each of our funds. We update it every quarter. We've been sharing the numbers with you all every quarter, but we thought it might be helpful for you to actually see the schedule we use to show how this is generated. We also thought it might be helpful to sort of show you over time how our forecasts have changed and how good or bad we've been at it. This is an interesting slide. Obviously, things took a big hit back in 14 and 15, and we took a look at that. And a lot of that actually had to do with two publicly owned companies that we had, Tango and Synacor, whose stocks tanked. So our expectations back in 2013, 2014 were higher for reasons that were unique to each of those companies. Their stock values went down. And then since 2016, we sort of been trying to climb our way back. Part of that was the Blue Ridge deal with Blue Planet Works, and now with Lumira taking off. You know, you can see here on the third quarter forecast we did for a brief moment there, we were actually forecasting more than 100% return of LP capital, and I suspect that will go back up in future quarters. But for now, as I said, we're just gonna stick with the schedule of at least returning limited partners capital. And so we're going to turn it over to Mark here to talk about some of the work that's been going on in terms of making sure we know what the prioritized payment liability is to SBA, and then also what we talked about last quarter, the management fees that we have not been taking since 2014. Now that it looks like we may have an opportunity to do better than just return capital, to see if we can't get agreement on recapturing some of that those management fees that have not been paid for 6 years. But are there any questions on the financial results of the forecasts or Lumira or Blue Ridge? Okay, I'll turn it over to Mark. I guess it's Mark and Tyler. This has been their
helpful first. Yeah, definitely. Tyler has been beyond helpful, extremely helpful in kind of going through a lot of the details on this, working with hold on a second. Working with PEF services. So we thought we would first talk about what the waterfall is, because it's starting to matter if Lumira does perform, kind of when different people get paid out, and it's a little bit unusual in a participating securities fund. And at least Carl will probably appreciate, this is something of a simplification, but it's generally correct. And we're going through to make sure we understand all the details at this point. But the first step with a big distribution would be a full return of capital to the partners, the LPs and the GPs. Then SBA receives its accrued prioritized payments. And that's that big amount that David mentioned in the previous slides, is around $27 million. Then after they've gotten the SBA has gotten their prioritized payments, then SBA gets profit sharing and profits on contributed capital, and would be shared with a proposed management fee recovery, which we talked a little bit about last time. And we've revised our proposal and have got more details that we'll talk to you about. And then after that, the general partner would get carried interest, but only after a 7% hurdle rate is achieved. So we'll show you what those numbers all look like. In terms of figuring out exactly what the liability is, we have engaged PEF services, and there's a participating securities distribution worksheet, the PSDWs, that have been completed for most prior years. Excuse me, but they haven't been given a lot of attention to for several years, given that it didn't look like that there would be a lot of distributions beyond, at the most, contributed capital. But now that it's looking like there's more, we wanted to make sure that they were accurate and make sure that the SBA was in agreement with them. So we engaged PEF Services, which is an outsourced fund management group that does a lot of work with SBIC funds and is one of the few experts on these old participating securities programs, to help us go through all of our old PSDW worksheets and simultaneously going through them with the people at the SBA to get agreement on that. That's been going on. It's been going on for a few months now. The person at the SBA does a couple years every few weeks, and there's sort of a regular dialogue back and forth that Tyler has been kind of helping guide and getting them the information that they need. At this moment, we have a pretty good handle on what the total prioritized payments will be. That number will be finalized. When the final year is done. But it looks like it's going to be about 27 million through 2019 that's owed to the SBA. But it continues to add around $750,000 a year. So that's the prioritized payment part. Then after the prioritized payments, the SBA will have profit sharing. It's a little over 11% that would be shared with all of the other partners, the LPs and the GPs. We're working to finalize all of that at this point. There's not a huge rush in that we need to have it done in the next few weeks or so, because it doesn't come into full effect until we're ready to make a distribution, but still helpful to have all together. And PEF has already given us an early draft of a full distribution waterfall worksheet that we could use, as well as the versions that we've already got ourselves. Any questions on kind of the waterfall or those prioritized payments? Okay, so then I guess next we'll talk about this, the idea of the contingent management fee. And we talked about this a little bit at the last meeting, and then we've revised our kind of proposal based on the feedback from the board here. But as a reminder, in May of 2014, the fund borrowed $4 million to pay off the SBA, which allowed us to get the fund raised for Fund 5, as well as not have the SBA put pressure on us to liquidate Blue Ridge or FitLinks/Numera, which I think ended up being good for all. As a result of the Blue Ridge and that loan, in order to take that out, had to be personally guaranteed by David and me. The loan was fully repaid in July of 2017 as a result of the Blue Ridge Blue Planet Works transaction. And the management fees from that period, from May 2014 through today, have continued to be recorded on all of the RSM audits and then backed out as waived by the management company. The total amount of fees waived from April 2014 through the end of this year is about $4 million. and they continue to accrue at a rate of around $560,000 a year, just based on the MSA, the Management Services Agreement, and have been continued to be waived up to this point. So what we would like to propose is that that fee become a contingent fee that we could get paid after the LPs have received their full return of capital and the SBA receives its full payment of prioritized payments, but that it would then still only be earned as the LPs are getting more than a one-time return on their investment. So specifically, after the LPs have gotten all their money, after the SBA has gotten a prioritized payment, it would then split 80-20 with the limited partners, or with the partners, the proceeds until the contingent management fee was fully repaid. Doing it that way also means that the SBA profit participation isn't impacted. A picture is worth 1,000 words, because it gets a little complicated. And this is a graph that's supposed to show what the LP's returns are at multiple different exit points along the way. The bottom axis is the total distributions, mostly from Lumira, that we could receive over time. And David mentioned various numbers from 25 to 30 million up to 80 million or 100 million that could be potential. And then the y-axis, the up-down axis, is the total distributions to the partners, specifically to the limited partners, and then we put the LP multiple on the far right axis. The dark blue area is what the limited partners would return, and you can see that up till about 25 million, the limited partners get the majority of the money. Then there's a long period from 25 up to around 50 million, where all of the capital is going to the SBA. And so the LPs are not getting any benefit of that. And that's where our current forecast is right around there. And it's what happens after that that we're asking about the proposed contingent management fee. And that is shaded in here as kind of this gold bar that would grow over during the next sort of several $10 million, $10, $30 million or so, to allow us to earn the $4 million of contingent management fees as the LPs get their full return. And because then the carried interest doesn't kick in until around 90 million of total proceeds. So part of the idea being that the general partner doesn't have any economic incentive from about 25 million all the way up to around 80 or 90 million without that proposed contingent fee, adding that back in. So that's kind of the picture, and then we can talk about sort of how specific what we've done so far. But any questions on kind of how that waterfall works or how it would get paid out?
This probably dovetails to where you're going next, but what other alternative payment mechanisms were considered?
So at one extreme, the Management Services Agreement says management fees are owed ahead of everyone else. That's what the Management Services Agreement says today. That we don't think that sounds fair in the slightest. So we didn't even consider proposing that. What we had talked about previously was that that fee would be paid after the SBA had gotten all of their money back. So the LPs would get all their money back, the SBA would get all their money back, and then the next $4 million would all go to the management company. And even as we were talking to you about it, and then we got feedback from the board as well, and we said we thought it would make more sense to have it almost be kind of like a mini carried interest in there. It was an 80-20 split to grow. So that's sort of how we kind of came to that proposal.
Thanks. And for clarity, aside from your break point at the $50 million threshold, there is no alternative mechanism. The SBA prioritized payment zone is what it is.
Yes, I mean, at least in theory, we could go back to the SBA and say, we want to get paid some of that management fee while you're getting your prioritized payment. I just think the chances of that happening are not that high.
Meaning you need their permission or you need a legal argument to present to them to get that.
We would certainly we would definitely need their permission.
Okay.
And then, the way to go about that, I'm not even sure.
Yep, no,
We-
I just,
With the management services agreement, we could have a legal argument that, we have an agreement that we're supposed to get paid ahead of them, ahead of the LPs and all. But I mean, it's a 20-year-old fund. We understand. that,
again, I'm asking, I have no iron in this fire with Fund 3. And so I'm simply posing some clarifying questions to understand where does the judgment begin to get applied? And it truly is at that inflection point at 50 million is where you're applying your judgment based on all the inputs that you've described, as well as what's on the following page. So thank you.
Yeah, no, that's right. And we felt that that this proposal does a better job of aligning us with the LPs, so that we start to make money when the LPs start to make money.
So does the SBA have to sign off on your proposed waterfall agreement?
Yeah, so that goes to the next the next step here. It's yes, they do. So what we've done so far since we last talked about this, first of all, we've gotten additional legal input. The fund's counsel is Alan Roth from Winston and Strawn. Alan's one of the leading SBA lawyers, and he has drafted an amendment to the management services agreement. And after discussing with him, he said, well, I mean, this change to the management services agreement is not technically detrimental to the LPs relative to the existing management services agreement. So as Bruce asked, the existing management services agreement says that the management fees all get paid ahead of the LPs getting their money back. So this is not detrimental to them in compared to the existing agreement. And every other change we've made to the management fee has been between the management company and the advisory board that we've made. So we've said, well, we're going to decrease management fees, or we're going to waive management fees. So that to make this change, that he didn't feel that we would need to go back to the limited partners to get full approval there. We would just need to get concurrence or approval from the advisory board, and we would need to have SBA approval. We then checked with our audit firm, RSM, and long story short, they said the same thing. And in terms of the accounting of it, since the management fees have been waived previously, we wouldn't want to or have to go back and amend prior audits. Given this structure, it can be a contingent fee that could be noted in the notes until they're actually earned, at which point they would then flow through the P&L of the fund statements. We've been in touch regularly and multiple times with Jacob Lewis, who's now effectively our analyst. He's the branch chief of the Office of Liquidation at the SBA, and have gotten multiple times have gotten input from him. This is the most recent from him, that he said that it's likely to be approved. They're going to go through the details. He doesn't think that there's going to be anything major, and that overall we don't think that they will be opposed to the overall concept. We wanted to have approval from them for this meeting. They seem to be extremely busy. I suspect COVID related, I'm not sure. And I've been gently pestering him for about 2 months, but this is the most recent input from them. They said, shouldn't be a problem, but we still need to go through the finer details.
And Mark, another clarifying question. On the legal input, change can occur with advisory board and SBA approval. Does the fund's operating agreement stipulate the advisory board approval is necessary, or this is a suggested step by legal input only?
So technically, the management services agreement is an agreement between North Atlantic Capital Corporation and the general partner. And so the agreement is really just between the two. And it doesn't have to have, at least on a pure, I guess on a pure legal sense, doesn't have to have anyone's input, but I don't think any of us think that would be a good idea. The Alan Roth didn't think it would be a good idea. The auditors didn't think it would be a good idea, and we wouldn't want to do it without the advisory board's consent.
And I ask that from a standpoint of just from pure governance, to understand the specific authority vested in the advisory board to take the action. And you've clarified that. And I happen to agree with you. I think that it's prudent to take the advice of your advisory board into consideration, even if it's not stipulated within the MSA and even if it's not required from a pure governance standpoint. So I thank you for clarifying. And hopefully that's for the benefit of the Fund 3 advisory board members.
Oh, it's good question. So this is the specifics of exactly what was drafted, and the actual complete draft is a very short addition to this in the appendix, the first page of the appendix. But this basically spells out exactly what I've said, that there would be 20% to the services company until the contingent fees are paid in full, and 80% to the general partner, private limited partners, as kind of the proposal after the limited partners have gotten a full return of capital and after the SBA has gotten all of its prioritized payments. And so what we would like to ask is if the advisory board has additional questions, and if they would be comfortable approving that amendment with the obvious stipulation that it would still be contingent upon SBA's final approval.
Mark, is there some magic to the 80-20 split?
No, other than it's kind of the customary, I guess, much like carried interest.
Okay.
Yeah, Mark and David, it's Carl. So I actually think that that's a equitable way of approaching it. I know we discussed it at the last board meeting, and I had similar questions and concerns that Bruce did, more from a governance perspective, but also, maybe you can address any sort of liability issues that the advisory board may have to consider if we are party to this change in the draft amendment to the MSA.
It's a good question. I want to give a knee-jerk reaction, but I probably shouldn't because I don't know the answer. I don't know what the liability is. David, do you have any sense?
I do, but it should be rechecked with council, and we'd be happy to do that. I mean, an advisory board is advising, not making decisions. And it may be the way, maybe that it needs to be incorporated into the language. We're seeking advice, not approval. So it's a really good point, and we should answer that question for Carl before we proceed. And I suggest we have a separate call just on this after we have an answer to that question, and maybe we'll have an answer from SBA as well.
Yeah, and a thought in that process is that, as you've pointed out, what you're doing is more favorable than what is presently dictated by your MSA.
That's right.
And whether and how that's incorporated and whether and how that may assuage at least Carl's concern of, is there an overhang of liability risk? Again, council would have to provide better comfort than any one of us could, but I would think that at least that consideration that this is a more favorable, now somebody could argue, but it could have been more favorable than that. Why didn't you advisors step in and beg for more or demand more? I mean, that's why attorneys make a living, but nonetheless, to me, having something that makes that affirmative statement of, whether it's notwithstanding or whatever, I realize some of that's here, but it's maybe not quite as overt as it could be to point out that this is distinctly more favorable than presently dictated. Just food for thought.
Right. And Bruce, that's the reason why I opened with my comment about the 80-20 split.
Yep, exactly.
But again, I think we should let David and Mark go back to Alan Roth and and get clarity on that, because we don't want to assume additional liability that we don't have to in this particular case, because this really management services agreement really should be between the management company and the GP.
Right.
That I think that's a great point, and we can draft with Alan's oversight, or have him draft a specific resolution that the board votes on or approves, that is advising that they think this is reasonable, or whatever the right term is that we want to use, that it isn't, the board isn't authorizing us, or isn't, that we can, I think we can get what we would like to have, kind of the consent of the board, without doing it in a way that should introduce additional liability to the board.
Perhaps the language would be specific to, waiver of liability.
Yep.
I just don't want the board to overstep its bounds. I mean, so we are here in an advisory board capacity. We're not here in terms of running the fund or making decisions around any sort of distribution. So.
Great. Well, we'll go do that. It may be a statement about the reasonableness of the general partner's approach, but we'll find out and make sure the liability is absolutely contained, and then schedule a call at some point. We'll see how things are going with SBA in terms of getting feedback there, because that would be helpful as well. So thank you for that.
Since I'm kind of new, I have a last question. Since I'm kind of new to this, I was thinking through the liability question, and it really comes down to who would be the stakeholders that would be aggrieved, I guess, if that's a word I can use. And it would be the other LPs in this case. Is that the group that would be
Potentially, yes.
really?
Yes.
Okay.
Yeah.
Okay.
Yeah, your job is to keep us honest in terms of, we do have the liability, we do have the decision-making authority, and your role is to keep us honest and protect the interests of the limited partners.
Okay. Yeah.
But I think, as we've said, I mean, this is actually a change to the agreement that's more favorable to the limited partners from a technical point of view, because it strings out the payment of the management fee instead of getting it all paid up front. Okay, I think we have our marching orders.
Yep.
And I'm sort of watching the clock a little bit, because I know Carl's up against the deadline. So thank you for that. We'll end this partnership annual board meeting and go on to Fund 4, which will be very quick. Carl, if you can stay on, I know you're an investor in Fund 4, so I think this one will go pretty quickly if you can stay on.
Sure.
So the minutes were distributed. Call the meeting to order. Entertain a motion to adopt the minutes from the September.
So moved.
Second.
All in favor? Okay.
Aye.
All in favor? Aye. Any opposed? No. Great. So the portfolio review is pretty simple. One remaining company. As I said, Invoke has had a tough year, as you can see down here on the bookings column, the lower right-hand graph. Their two good quarters of the year typically are the second and third quarter. They didn't hit those bookings at all, and it hit their revenue. The good news, I guess, is from a EBITDA. I mean, they've controlled costs, so from an EBITDA point of view, they're actually pretty close to where they were on a trailing 12 months basis prior year. Now that's thanks to the PPP loans, because the losses, the net income was quite a bit worse, as you can see, on a trailing 12 months basis. But there's the fourth quarter, they've had some pretty good bookings, actually quite good bookings so far in the fourth quarter. It appears that the studios some of them are going back to work, creating content. In the meantime, the company has actually added a number of studios. If I forget how much we've talked about, but studios, when they create a movie or a series, a film of any kind, one of the ways, the most common way historically that they've actually gotten consumer feedback as they're making changes before the final release, is they actually have these little studios in malls around the retail malls, and they pull people out of the malls in the studios. They have them watch the early the work in process of the films, make comments, and then they go out into the malls again and they take that content, they take that feedback and adjust the content. What Invoke does is Invoke does that virtually, which is, you know, sort of the way the world is headed. Everything's being done virtually. People don't want to congregate in small rooms. So the studios have begun this year to recognize that this can be done more efficiently, but also obviously more safely by doing it online. So during the period when they've not been booking business, they've been generating quite a lot of interest in what they do, and have actually signed up a bunch of new accounts, both in the movie theater production area, but also interestingly gaming, which is a huge market, even bigger. The gaming industry also is starting to catch on to doing content assessment before a major release. So they're building on that. They've also been doing some work for Facebook. So there's some opportunities in the tech sector as well. This is just one of the slides from a recent board meeting. We actually have a board meeting tomorrow. It's sort of some indication of the work that the company has been doing in the area of marketing with a new website, very active in blogs, and they're really getting a lot more sort of prospecting activity with major studios, even though they haven't been able to do much work for them. But now that the studios are opening up, they're beginning to do, create content, which the company is actually working with these studios doing assessment on. So things are looking up, but it's still uncertain because a lot depends on how quickly COVID can be eradicated, whether through, the rollout of vaccines or whatever. But there has, overlying through all of this, has been a trend that in-person movie theaters are probably going to take a long-term hit, and that a lot of this content now is going to be streaming content online. The content world is still growing. A lot of it will be delivered online. And sort of one of the arguments that Invoke has is that, well, why not do your assessment of this content work in the same circumstance in which the consumer, the viewer, will actually be watching the content. So actually doing it in an in-home environment online is consistent with how people are going to be watching this content more in the future. So we're cautiously optimistic. There's work to be done. The company does have cash on its balance sheet without any borrowings. And our hope is that the company can continue to grow and that we can find a home for the company next year. We do have cash, which you'll see on our balance sheet, which we could use if we had to support the company through a sale. But everybody, the management team and ourselves, we basically have one other very small investor, a guy named Rory Cowan, he was on the board and been very helpful to the company. We're all focused on getting the company sold next year. So any questions? So we'll turn this back over to Tyler. Talk about numbers.
All right. So the change in portfolio company values was just a decrease of $1,600. Such a small amount that it doesn't even look like the line's showing up in that middle column. But of the $1,600, there was a big swing in terms of what drove the change. The multiples for the public companies that we compared to Invoke increased by 19% since the second quarter. So this drove the valuation up $705,000. The company's financial performance, though, as David mentioned, the revenues declined some, and they've had some decline in cash. That forced the valuation lower. However, a big part of that $706,000 decrease is actually due to us increasing our discount. For all of our valuations, we don't just take the public comp multiples. We have we discount them all typically in the range of 25 to 50-ish%. And on this one, we did increase the discount due to the revenue impacts and other impacts that COVID's caused. So while it says financial performance, a big chunk of that too is related to the discount. And so in total, it netted out to a small $1,650 decrease. So looking at the 2020 forecast as a whole, starting with the Q3 actual results, there was small idle interest income of $371. The fund had $53,000 of expenses in the third quarter, of which most was management fees. So the net ordinary income ended up at negative $53,000, and with the small write-down in Invoke, the total change in partners' capital was negative $55,000. Going down into the third quarter balance sheet, total investments remained flat at $4.3 million. We still have about $1.5 million of cash on the balance sheet. So total assets come in at roughly $5.8 million. There's no liabilities in this fund. And so that $5.8 million is also the partner's capital balance. Looking at the year as a whole, there was small interest income on the year of $1,500. We had expenses of $255,000, which is comparable to the expenses in 2019. The slight increase is mostly related to increased audit and tax fees and a little increase in legal costs, I believe. And so net ordinary income was negative $253,000. And so far, year to date, we've had write-downs for Invoke of $1.1 million. On the balance sheet side, the balance sheet does look pretty similar to last year, with the exception of the $1.1 million write-down in total investments. So the total assets are down $1.4 million, and partners' capital is also down $1.4 million. So looking at 2020 or 2021, the big event in the fund in 2021 is that we're forecasting an exit of Invoke in Q4 that will result in $8 million of proceeds to North Atlantic. And so how this impacts the income statement is, for the year we're forecasting $1,400 of investment income, a similar amount of total expenses of $255,000 for an ordinary income of a $254,000 loss. The Invoke will be, to reach the 8 million, Invoke's value will increase about 3.7 million. And so for the year, the total change in partners' capital will be $3.5 million increase. And since the remaining portfolio company will be winding down, we're forecasting the final distribution in Q4 next year. And so total assets on the balance sheet will go to zero, and the final distribution to the GPs and LP will total $9.2 million.
And the Life of Funds forecast, same format as Fund 3 and Fund 5. The 2021 column is basically what Tyler just described, where we expect our forecasting about $8 million distribution from the liquidation of Invoke. And as you can see how that flows through, we will have that cash that Tyler talked about as well. So the distributions to the partners is $9.2 million. So this is our same chart comparing all the forecasts we've done in the past. Interesting, and Mark pointed this out. We had the same issue in 2014 and 15 with a decline, and that was actually from the same two public companies. As you may remember, Fund 3 and 4 both invested in Tango and Synacor, and so when the stock prices for those companies declined in 2014 mostly, that basically hit our forecast for the future performance of the fund. Interestingly, since then, The multiple hasn't actually changed very much, 'cause I think most of this is the same company as Invoke. So we haven't really changed our forecasted exit value for Invoke all that much. But because of the passage of time, the IRR logically declines. So we are, still projecting about the same number, a 1.75x multiple and an 8.5% IRR to the limited partners when the fund is completely liquidated, hopefully next year. And that's it for this fund. So happy to entertain any questions before we move on. This one's pretty simple. We are spending a lot of time making sure Invoke is getting a lot of our attention. Regular conversations, regular board meetings, particularly during this this period of rapid change. And hopefully, I'm pretty optimistic that we can have a reasonably good year next year. Any questions?
I actually think, David, the thing that you touched upon briefly of getting into the gaming market, I don't fully understand watching people play video games, but I have so many friends that love the esports industry so much. And so I really think that getting involved in that industry is another launching point for them.
Yeah, good point. And actually EA Sports is one of the ones that they've landed. It's a huge company in terms of gaming. So yeah, I agree. It's a little bit of an unknown. We've been in the theater business now for 3 years, I think, and gaming is new, but they're, as we've learned, because we've looked at a couple of gaming companies, they're very, very analytical, very, very numbers oriented. So the idea of actually doing assessments before launches is sort of consistent with the culture of the gaming industry. So we'll see. I look forward to reporting on a quarterly basis. Any other questions? Mark, do you have any thoughts to add?
No, I don't think so. It's pretty straightforward on that one.
This one's pretty simple. Yeah.
Yep.
Okay. If there are no other questions, Carl, thank you very much for hanging in there. As you predicted, we weren't going to get through 2 funds in an hour and a half. So you were right. And
Well, terrific. Everybody have a nice holiday. Stay
Take care,
safe,
Carl.
stay healthy.
thank you,
And
Carl.
we'll
You
talk
As well.
You
Thank
too.
you.
We may be back to you for a brief call on Fund 3, but thank you for joining.
Okay, thanks again.
Thank
Yeah,
you.
bye.
Bye-bye.
Okay, so that concludes the advisory board meeting for North Atlantic SBIC 4. We will open the meeting of North Atlantic Venture Fund 5 and entertain a motion on the minutes.
Motion, Bruce.
Okay, thanks, Bruce. Is there a second?
Second.
Okay, all in favor?
Aye.
Any opposed? Hearing none. Adopted. Thank you. Okay. So we got a bunch more companies to talk about here. We're actually quite excited about this portfolio. COVID notwithstanding, COVID really has kind of, for many of these companies, has actually validated their model. I mean, all of these companies are B2B, most, essentially virtual. All these companies are operating from home still, with a couple of exceptions. And they've just kept on chugging. Some have had temporary slowdowns because of what's going on in the market of their customers. But by and large, the business model is in line actually with an economy that's going to be more virtual and less in person. Our companies don't build anything. There's no inventory. There's no factory. It's amazing to see how they've been able to just continue to chug along. The first one here is Boost. If you remember, Boost is a virtual card business. They work with a lot of the major money center banks and the card issuers, card companies. MasterCard is a big part of their business. They just actually landed Visa, which is going to now, we just got this morning, just got a letter that Visa sent out to all of their corporate customers about Boost and being their partner. and trying to transition them onto the virtual card as a payment process. So, huge endorsement. The metric that we watch most consistently is down in the lower right-hand corner there. The success of the business depends upon building relationships between buyers and suppliers, so that one will actually make payments using the Boost system and the other will accept payments using the Boost system. So all of this has been going on. I can't really tell you why the fourth quarter last year was so bad. I suspect that the second and third quarter, the second and third quarter were certainly slower than the third quarter back in 2019. And that in terms of landing new buyer-supplier relationships, we're sort of back to equivalency with 2019. And that should just continue to grow. And with companies like Visa now out promoting the buyer-supplier relationships within their network of commercial customers, it should just continue to grow. So we're feeling pretty good about the company. Revenue was quite flat over the last 4 quarters, even though buyer-supplier relationships were growing. They had a lot of customers that were in the travel entertainment business, so revenue per customer went down, even though the customer count went up. The company is well capitalized, has adequate capital. Right now, they are actually they have good relationships at Stifel, interestingly, both with Stifel Investment Bank and Keefe Bruyette Woods within Stifel. Stifel's actually, based on a recommendation, an introduction that, or thought that we presented, actually their Stifel's lending group, technology lending group, is actually talking to Boost about possibly lending them money to buy us out of our debt. So Stifel's actually been through almost all of our companies, met with them, talked to them about relationships. I think that's part of why Stifel's gotten pretty excited about us, is that they see the fit, and Boost is just another example of that. So here's an example of a slide out of the Boost, their quarterly board report, just showing that across the board, even though they've been flat, relatively flat, they have been growing, but relatively flat for a couple of quarters off of Q4 2019 on a year-over-year basis. They've had some nice growth. You can see the company's international. They're in 36 countries. This buyer-supplier relationship metric down here is really, really important. But they're actually chugging along at a pretty good pace. So happy to entertain any questions on Boost before we move on. Okay. Mark?
Chartbeat. Chartbeat is real-time data analytics for major media companies around the world. They help them make decisions on which stories to have where on their web pages, and what the headlines should be, and so on. And the company is relatively dominant in that space, but it's a small market, and B, a shrinking market, which has made it a challenging business overall. Those challenges were added to a bit at the end of the third quarter. They lost one of their largest customer at the end of the third quarter was MSN, Microsoft's MSN network. And they specifically lost, and they didn't lose them to a competitor or to anything else, but MSN, the webpage, had, I think it was a few hundred different people, editorial content, who would provide editorial content and curate stories that went on the MSN website. And Microsoft decided to go with a purely automated approach, where they would have they've laid off over half of their editorial folks, and went with an AI engine to just post the stories up as the engine saw fit. So it was an unfortunate loss for Chartbeat, but they've known they're in a tough market for a while, and the board has been guiding them to look for other growth areas. And they've been working on a number of different things. They've got 2 new products that are coming out in the fourth quarter that are still targeted at the media market. They seem like products that the people are really interested in and should help their Q4 sales quite a bit, but it's still in that media market. And then they have another product that they're working on to get them outside of the media market using some of their same technology, but expanding into what could be a much bigger market that could be a Q1 or Q2 kind of launch. But at the same time, the board knows that this company would be better off in a home somewhere else, and so has started asking to the management has started looking more seriously at strategic alternatives. They're in the process right now of hiring an M&A advisor that could help, and it's not something that they're going to be starting a process right away, but they are a sale process right away, but they are going to be starting a process on positioning and outreach and making sure they're in front of the right potential buyers to target a sale in the second half of 2021. So we now have this in our forecast as an exit for the end of 2021. And they're, they think that's a reasonable outcome and are not expecting a big multiple on that. And you can pop ahead, yeah. And then this just thought this was kind of interesting, given their role in with all of the major news organizations across the world. Election Day is a really big day for them. It is their biggest day of the year, biggest day of every 4 years, and this past Election Day was their biggest day ever. They were at the peak, serving over 588,000 requests per second as people were going on New York Times, Fox News, CNN, and all the other sites that people go on to, refreshing web pages and all, and they had no downtime, and their customers were very happy that they were doing everything that they should be doing. But just kind of interesting to know what's going on in the background as many of us were hitting refresh on some of those websites on a regular basis, that some of the analytics and all that were helping those companies decide what news stories to post and where to put them, and how to best engage with their customers was being driven by Chartbeat. Any questions on Chartbeat?
Okay, Elevation is our ed tech company. If you remember, their software is used for school districts to manage English language learning populations. Most of it has been administrative, but they're actually moving into content where they're providing actual instruction software delivery programs. And with schools being shut down this year, we were, not only we, but the company was actually quite concerned about what was going to happen to their business and their plans for the year. As you can see from the net bookings graph, I mean, they typically do a lot of their bookings in one quarter. Their quarterly, their comparable quarter, which third quarter that they just had, was down from last year. But interestingly enough, and Tyler's been tracking this information pretty closely, what actually has happened this year, it looks like the fourth quarter will be pretty strong. They're actually going to have a good year, but the bookings got spread out a little bit. So they didn't have as strong a third quarter, but their year, the year should be equivalent in terms of adding new bookings as it was in 2019. So they've actually been doing a lot better than anybody thought they would be doing when COVID first hit and schools started to get shut down. It looks like they'll do about a 25% revenue growth this year, which is really fantastic. They have really watched their expenses, so you can see their bottom line has improved quite a bit. Their margins are actually better, and fortuitously, they raised $15 million in new equity at a premium price in April, just as everything was beginning to come apart. So the company's actually doing pretty well, and doing so well that they've actually found a bank that is going to lend them the money to take out our debt. And that should close, it may close tomorrow. We've actually provided a payoff letter. So we are likely to get $5 million of cash back in tomorrow. We will still have our equity ownership, which is about 1.5% of the company. The investor who actually came in and led the round back in April has approached us and asked us if we would be willing to sell that. They would like to own more of the company, and we did have a conversation with them a couple of months ago when the buyout of our debt was first introduced, and we said, well, why don't we basically said, well, we might consider it at the last round price, the price you came in at. That would mean buying our old equity, which we paid nothing for because it was penny warrants, on a fully priced basis. But actually now, if they do come back to us, we may want to asked for a little bit more. It's the difference between probably 1.7 and $2 million of additional proceeds. But there may be an opportunity to totally cash out of this investment, or we could just hang on to the equity over time. We think it's fully priced. I think there's some risk in the company entering in the content business, which is much more competitive. So I think right now the attitude of the company is that they can do anything, and maybe they can, but this might be a good time to get out of the investment altogether and show a very nice return. This is just some of the metrics from their slide deck. As you can see, it's one of those nice steady up and to the right sets of graphs. I won't go through all of them, but they have maybe the most important one is that number up in the right, the net retention. I don't know if we've talked a lot about the difference between gross retention and net retention, but net retention is basically the business you retain plus the upsells to existing customers. So, from the customers that they started the year out with, they'll lose some customers, but the upsells that they get from the other existing customers more than offset that. So net retention is a really key metric in these SaaS companies. So they've got nice metrics, nice growth, over $20 million of committed annual recurring revenue. And this is why the company's feeling good about itself, and why a new lender is willing to come in and take out our debt, and the company feeling comfortable that they can do that and still have the liquidity to run the business efficiently. So that's Elevation. Any questions?
LendKey, you'll recall, is primarily in the business of originating and servicing student loans and private student loans, and that business has certainly been impacted by COVID, and it was most strongly felt in the year in the third quarter. Though, in looking down in the bottom right, the loan originations, you can see in September of 2019 they had a big quarter, as they always do, because that's when students go back to school. In September of 2020, it was still up, but it wasn't up nearly as much. And obviously that's been driven by the number of students either deciding to not go back to school, take gap quarters or gap semesters, or going back to school but not using room and board, doing remote learning and all from home. So across the industry, a big decrease in student loan originations, and then that's new student loans or private student loans, and then secondarily refinancings have also taken a hit as a result of the CARES Act, where government student loans are at 0% interest and no principal payments due. So no one's refinancing those right now, and that's a relatively small part of their business, but it does have an impact on them as well. I'd say amazingly, but it's a really good management team here, and even heading into 2020. Before the pandemic hit, management had already taken a number of expense reductions and cuts, and was very careful throughout the year. Knew there was going to be significantly less student loan origination, so didn't spend nearly as much in marketing as they have in the past. So as you can see there, their revenue is down over the last 12 months. Profitability is way up. So revenue dropped from 27 million to 25, but they went from a loss of 3.5 million to a positive EBITDA of 1.8 million during that same period. So a really nice job kind of managing things. Then they have now over $10 million of cash on the balance sheet. So the business is fine, and for the most part, particularly new student loans, people think will recover to a large extent. Refinancings could continue to be depressed depending on what happens with extending the CARES Act, forgiving student debt, and those kinds of things, which has the management and has had the management and the board looking at other alternatives for LendKey to generate revenue and grow. One of the areas that they focused on is home improvement loans and some other avenues for generating originations in unsecured private loans that have some similar characteristics to student loans, and that's going okay. But the bigger initiative that they've been working on is called the debt sale platform. It's eventually going to have a better brand name, but this is taking advantage of a lot of their back-end technology and allows marketplace lenders, folks like SoFi and Rocket Mortgage and folks like that, who do a lot of loan origination, to, on a forward basis, sell their loans to credit unions and small community banks in a very transparent and easy way. And they've got some great technology that allows that to happen. They've spent time talking to both their credit unions and banks, as well as to a number of these marketplace lenders, and there seems to be really high interest in that product. This is just a snapshot of what their pipeline looks like, and it's in terms of loan originations, and over probably the most relevant numbers at the bottom, the $6 billion number, and this is over a little more than a year, but they would expect that they could get somewhere between $2 and $6 billion of originations flowing through this platform. They would be getting somewhere between 10 and 25 basis points on those to act as lender servicing with these loans, and they're expecting to launch this product in January, and hopefully have their first customers on that, and we'll have a better sense of whether it is likely to generate future growth for LendKey.
Any questions? Okay, as I said, InMarket was a big event for us this year. Ninth Decimal was a big event, getting acquired by InMarket. And again, thank you to Mark for getting it across the finish line while I was sailing off the coast of Maine, blissfully. It was a heavy lift. This was a big event for us. Ninth Decimal was an ad tech company doing mostly data and analytics. Had a good book of business, but they just couldn't seem to find a way to make money. A whole host of issues. Basically, a company with a pretty good management team, a good product in the market that was being used by very sophisticated customers, but they just could not get properly capitalized and make money. So InMarket was actually our third run at finding a home for the company, and I think we ended up with, fortunately, the best option. The numbers that are on here do not include, these are just InMarket's numbers. They do not include the addition of Ninth Decimal's revenue margins and new customers and new sales. But as you can see, Chip's in the waiting room. Thank you, Barbara. I don't know why the waiting room didn't show up here. Sorry. I'm going to have to get out of screen share, I think, to let Chip in. All right. Chip? I did let him in. Chip, are you there?
I'm here, David.
Hey, great. Thanks for joining us. I hope you weren't waiting too long. I didn't see you because I was on screen share.
Yeah, it's happened before in other calls. That's why I called Barbara and said, hey, let me in.
Yeah, thank you. Thanks for doing that.
Yeah,
we've got everybody else on. Carl was on early for the Fund 3 and 4, and he's dropped off. So thank you for joining. We're just we're going through the deck here and the portfolio companies. So really appreciate your joining. Do we have you for a while now, or?
Yeah, I'm good.
Okay,
for the
great.
balance. Yeah.
Excellent. So we're just talking about what a big deal it was to get Ninth Decimal sold. So the numbers that are here these are just in markets numbers without Ninth Decimal being added. So the transaction happened the first week in September. So you can see, these numbers here, in market without Ninth Decimal was a company was growing 83%. Net income growing, good net income, good EBITDA, good margins, and Ninth Decimal joining is just going to be additive to this. So we now have ownership in a company that has combined revenue of over $100 million run rate. It's profitable and growing. And I think these, the next time we report, you'll see the Ninth Decimal numbers added onto the in-market numbers. We haven't quite gotten the KPIs worked out yet with in-market. We had to negotiate a non-disclosure agreement with them, which we now have in place. And hopefully by the next time we report, we'll actually have some KPIs to report as well. But it's a good team. The company in-market is in LA. Ninth Decimal's team is in San Francisco. So they're two West Coast companies. They both do have a presence more for sales and marketing in New York as well. So in market, kind of ironically, in market was a little bit like our company Keep, which we sold to Ninth Decimal. But they had a great customer list. They basically place ads on social media for large retailers. Ninth Decimal's data and analytics are a perfect combination of that. So they really have a very strong unified platform now. One of the strongest offerings in the marketplace today for placing, analyzing, and optimizing marketing spend for major retailers around the country. So really, really happy with this and look forward to reporting more on it in the future. Any questions? I guess I'd make one other comment. The in-market team is very intent on making a lot of money, which we like to hear. The CEO has said he wants to make a lot of money so he can go into philanthropy before his career's out. So he kind of has an objective. I think there is sort of a path to liquidity here, whether it's an IPO or an acquisition, but we've got it in as a 2023 exit. If there are no questions, so Nonstop is doing fine. We actually thought there might have been an exit opportunity here. They'd hired an investment banker. They did get some offers. To do a recap, they decided that the offers were not attractive enough, so that ceased. I think they did actually learn quite a bit through the process, but if you remember, the company provides health insurance services, administration services. When we invested, it was mostly to nonprofits, and now they've also added a direct channel to small businesses in the for-profit sector. And the early indications are that that's actually going to be a good move for them. The revenue growth this year was a little disappointing at 10%. Some of that was COVID related, just hard to get a hold of people to make decisions to change their healthcare plans. Part of it was some of their nonprofit healthcare clients cut back their population, so they had fewer heads to insure. But the company's operating profitably, which is very profitably actually, and management's intent is to grow the company more aggressively, probably in the 20 to 30% range next year, and to continue to grow it profitably. So our debt investment is quite comfortably secure. Our equity upside here is reasonable with 3% ownership. It's a nice little investment that we don't lose much sleep over. Here are some of the metrics. These go back to the founding of the company. So I think one of the most important ones to us is this commitment to positive EBITDA for the company and seeing cash increase from operations as opposed to from raising money. So nice little company. We think we're going to do quite well on this. The the management team that founded it is interested, obviously, in an exit opportunity in the next couple of years, as evidenced by the fact that they hired the banker to take a look at it this year. So we forecasted the exit in 2022. Be happy to answer any questions. Okay. So Springbot is a company that we have been a little concerned about, but it's starting to do better. Springbot provides software to small retailers so that they can have an online presence and online relationship with their customers. And they had been pretty flat, as you can see up here in the upper right-hand corner, even down and a bit, but they're starting to have some good bookings. So you can see here, the third quarter was a really good bookings quarter, and it looks like that's continuing. So we're hopeful that things are going to improve. The company also just closed a very small tuck-in acquisition and raised some additional equity as part of that. So the growth rate next year should probably start to pop up into the double digits, which would be good. I think our biggest concern here is that the company just continues to burn an awful lot of cash. It's just for some reason the sales isn't as productive as we'd like to see it. Although that may be changing, and it may be that COVID has actually helped this company, because it looks like this spike is probably a response by small retailers realizing they've got to do more online business as a proportion of their overall revenue. This may be some evidence of that. This is out of a recent board slide. This is revenue store performance of their customers. The red line being 2019, and I really don't know what this seasonality is here, but the spread here that started to happen in April when COVID hit, I think is an indication that their customers are doing more business online, and it's probably driving some of that those bookings that we saw in the third quarter and are continuing to see in the fourth quarter. So I think the model is right for the times. I am concerned about the cash burn. The new money they raised and the new acquisition they just did, I think will help extend the runway, but the company's still not fully capitalized the way essentially all of our other companies seem to be at this point in time. So there may be the need to raise more equity sometime mid 2021. Okay, any thoughts or questions there? Over to Mark.
So Suzy, you'll recall what they call a on-demand insights platforms, basically rapid surveys for major brands that they sell on a subscription basis. And they've really been hitting their stride from a sales perspective, with revenue up 41% in the year over year and up 58% Q3 versus Q3 last year. Very strong pipeline and generally performing quite well. They're spending a lot, investing heavily, both in sales and marketing and in new product, and making sure that they're really focusing on bigger and bigger accounts, where initially they had kind of been more mid-market and some larger market, and they found that the big companies are really where most of the interest is. So they're making sure that they've got the tools and a product that those customers demand. And as much as they're spending, they're raising capital at increasing valuations along the way to support that. In the first quarter, they had raised 16 million of equity, and they raised an additional 10 million in the third quarter at a further increased value. So continuing to add to their capital base and planning heavy growth and heavy spending into next year. On the next slide shows some of the biggest enterprise customers. These are their top 10 customers. And David talked a little bit about net revenue retention in an earlier slide. And these big customers are growing a lot. These customers are more than doubled in the past year, and are about 30% of their business. And they're looking to continue to add more customers of this size and grow these customers to even bigger and bigger accounts. And the pipeline keeps getting bigger as well. So they've got their pipeline heading into Q4, which is usually a big quarter for them, is at its all-time high as well. Any questions on Suzy?
We kind of joke Suzy would be a star of the portfolio if it wasn't for Wasabi.
Yep.
So Wasabi is looking like a real rocket ship these days. We have, this was a straight equity investment, so it's a little different from our sub-debt with warrants investments. And just as a reminder, we got very comfortable with that because the Wasabi team was a seasoned team that had done it before. I think this is their 6th or so startup. Their last one was Carbonite, which went public. It was also in the data storage business. And they've just been hitting their numbers. I mean, they had an aggressive plan and they're running right on their plan. They are spending a lot of money, but they've been able to raise money to do that. And this is a cloud storage business that competes with Amazon Web Services and others, other giants. I mean, but it's such a huge market. The market itself is growing, and there are unique pockets of the market that are just ripe for the picking. They're not taking business away from the big guys. There's just all kinds of greenfield markets. And one example is surveillance. I mean, surveillance cameras are getting more and more ubiquitous. Almost all surveillance data is stored on premises, and it's now beginning to move to the cloud. And the company's found a nice little niche there in the marketplace that's growing very rapidly. But I think one of the key things that they did early on is that they discovered it in their European operation first, but that most cloud services are actually bought through the channel. So they've developed a very productive channel of partners and resellers who are just bringing business in as fast as they can handle it. The company's only real barrier to growth is, as the company itself says, is access to capital. So they're just in the middle of closing a $22.5 million debt round. This is being used, the debt's being used primarily to fund the data centers, the equipment, and then the equity that they raise is being used to fund operating losses. The operating losses are, the equity that there's an equity raise initiated now looking for $75 to $100 million. They hope to close in the first quarter. We've got a board meeting next week. I'll get more up to date on that right now, but it appears that there's real interest out there at a premium valuation from what it's being held on our books at. Right now, we're holding it at cost. We did not write up, even though we had a bump in the second tranche that we invested in. We have not written this investment up at all. It's just sitting on our books at cost. Some of the kind of reasons that we get excited about this, these are net paid terabytes of storage per week. This is not cumulative. This is incremental. So you can see just in the last month or so, they have really begun to book an awful lot of new business. This here is cumulative, but it's this kind of explosive growth that is getting the company excited. The other thing that's sort of very material is that they were written up recently by IDC, analytics company that follows the market space. And there were only 6 companies listed in their in the landscape here, this landscape schematic. Obviously, Amazon Web Services is the big guy, with Microsoft as being in the leader category. Major players, Google and IBM. Wasabi just out of the major players category as a contender. And the only other company is Oracle. And it's interesting that Wasabi is deemed to have better strategies than IBM or Oracle. So the fact that Wasabi is on this chart the way it is, this is a company doing $10 million of revenue. these guys are huge, is a testament to the fact that the company's getting some real recognition um, by market observers, but more importantly, getting recognition by customers and prospects. So we're looking for another good year. The fundraise is something we're watching closely in terms of valuation. Their sense is that the pre-money valuation, they've been told, should probably be around $400 million. So as we think out, well, if that's true, what could this company be worth in 2 or 3 or 4 years at the time we might exit? And it's going to be in the unicorn category of north of $1 billion. So
David, what was the post money value on your equity investment at 8 million?
Tyler, I think it was the last round, I think was 240. Tyler, do you remember?
Yeah, that sounds about right. It was low 200s, I think. I was thinking 225 on the latest 4, and then I think the first 4 was around 175 or 160, something in that range. The original 4.
That sounds right.
So a prospective meaningful write-up in the first quarter.
Yeah, so we would get to write up both of those 2 rounds. We own 4% of the company. We have an ability to participate in this next round. Our intention is to try to maintain our ownership in the 3-4% range. So, you can do the math. If the company's worth $1.5 billion, well, you'll see the math in a bit. This will be a pretty meaningful investment. Because this is purely an equity investment, not a sub-debt with warrants, there's a lot more beta, a lot more variability in terms of what could happen here. But the numbers are just, month to month to month so consistent. And the team is seasoned. They're in a marketplace that's growing. They're competing effectively. And I think we mentioned this before. They're competing against those big guys with a price point that's somewhere in the range of 20% for storage. And the big guys, particularly Amazon Web Services, nobody likes them because they charge every time you want to take data out or put it back in again. And Wasabi doesn't charge those egress fees. So they've got a hot product in a growing market. And, some people have said, well, what if everybody starts to get into a price war? Well, first of all, we've got a lot of room to play with because we're selling at 20% of what other market leaders are selling at. But the other is, I don't think Amazon wants to get into a price war. They're making, or the big guys. I mean, the market is so big and growing so fast. There's really no reason that there would be a price war. But I don't think it would affect Wasabi anyways, so by that much. Any other questions? Okay, and finally, Signal. Signal's doing a lot better. We've always felt this company was undercapitalized, and it still is. This company monitors social media, looks for media trends, looks for bots, looks for false media, and is used by some very sophisticated private companies like JP Morgan Chase. We've said in the past, Jamie Dimon has one of their systems in his own office, but the big opportunity more recently has been in the government markets. And the company has, the bookings is lumpy in government, as you can see from the lower right-hand graph here. We had a really big bookings quarter, a big record bookings quarter in the second quarter. Things were off a little bit, and they're expecting a pretty good bookings quarter in the fourth quarter here as well. But the company is growing, could be growing faster, we think. But 25% growth this year is good, still burning a lot of cash. Which is not good, obviously. But importantly, we expect that the company will be closing a significant senior debt round. The current senior lenders, senior debt's $7.5 million senior to us, and they're closing around at 13 million with an option to go to $15 million of debt on a senior basis based on performance. Now, obviously, we're not, we have agreed to that that increase in the debt senior to us, and we're getting paid for that with additional warrants. We like the new senior lender, but feel, and that will actually properly capitalize the company in the short run, but probably we'll be looking at an equity raise probably in the middle of next year. There are some strategic players poking around that are interested in the company, but it's pretty early and pretty premature. So we're forecasting an exit in 2022. Although I'd say the other investors are, I mean, they think that this company has the potential to do better over time, and they may want to extend that that exit out a little bit. But the way our deal is structured, we're going to do pretty well in almost any scenario with our sub debt with warrants and multiple liquidation preferences. This is just a simple graph out of their board deck, including year-to-date new annual recurring revenue versus first 9 months of last year was up. That's primarily the really good second quarter they had. So feeling this one's been de-risked a bit, sort of similar to Springbot, but still burning more cash than I guess we're totally comfortable with. But we're on the boards of both of those companies, so we've got a say and an influence in what's going on. Any questions on Signal? Okay, I'll turn it over to Tyler.
So this is our portfolio company reserves analysis. I think we did a pretty thorough deep dive on it last quarter. But so far for 2020, we've made 4 follow-on investments. We invested $241,000 in Elevation back in the first quarter. We made a $4 million follow-on in Wasabi. I believe that was the second quarter. And then we've made 2 follow-ons in Signal, one for $1 million in a convertible note that actually converted to equity, I think this past week or so, along with a $500,000 follow-on of our subordinated debenture note. So in the gross reserves column, David and Mark have provided what they feel is what we may have to, in certain circumstances, invest in some of our portfolio companies, and then we weighted those reserves amounts for the likelihood that it occurs. The weighted reserves amount totals 6.3 million, which can be covered by our line of credit that we have on this fund. But this 6.3 does include, some of these are much more of offensive plays than true, I guess we'd call like reserves of the company needing cash to get to a liquidation event. Some of them are more offensive plays. So the 6.3, as far as a defensive reserves amount, it would be quite a bit lower. So the third quarter change in portfolio company values. For the quarter, the fair value of investments increased from 94.5 million to 96.3. $500,000 of that was the additional investment in Signal in our subordinated debenture note. And then 1.2 million was appreciation on our investments, of which mostly is related to the 90 in-market deal that occurred. So to go through the portfolio valuations on how we got to the 1.2, Lenke had a $93,000 increase in valuation. A lot of that was related to the market. It looks like a big increase, 300,000, but the comps were up 11% in the third quarter, but on the year they're still down 15%. So back in the first quarter, in that market column, we had $100 or $1 million write down of Lenke. So this is still kind of clawing back there. And then their financial performance, as Mark mentioned, revenue did decline for Lenke, although they got more profitable. So that's why that decline is there. For Keep, we wrote down the investment $50,000 more. All that's left is in their bank account. They had some accounts receivables, and it seems like we had it on the books at 100,000. It seems like the final distribution is going to be about 50, so we wrote it down further. Ninth Decimal had a large increase of 1.3 million. And this is mostly related to the structure of the Ninth Decimal in-market deal. We had a $8 million note at Ninth Decimal that was converted into equity security at Series F. It's the most senior security, and it came with a 1.5 X liquidation preference. So we're at the top of the stack, and we're getting 1.5. So the first 12 million that goes to Ninth Decimal investors will all go to North Atlantic. And so that the change of the structure drove up the value on our books, as well as just being in a more established company that's profitable, de-risked some of our discounts that we had. Signal had a small write-up that was mostly related to revenue increase. Chartbeat was written down 329,000. Part of this was about half was related to the market. The comps went down 17% in the third quarter, but the financial performance actually didn't decrease that much. But because of that large customer loss that Mark mentioned, we increased our discount on this investment because we're expecting revenue to decline, but it hadn't yet, so we did increase the discount. So Wasabi is still held at cost, as David mentioned. Springbot has a accruing dividend, so you'll probably get used to seeing this $100,000 write-up on Springbot. Our preferred shares have an accruing dividend that's accruing around 100,000 a quarter, so that has stayed consistent as the preference is fully being supported. Nonstop had small write-ups as a result of a slight increase in market multiples and slight increase in revenue. Suzy had no change in valuation, as the valuation is based on the most recent equity round that they completed. Boost had a small write-down, mostly due to market comps decreased slightly. They had increased a lot in 2019, and so far this year, the public comps have decreased slightly throughout the year, each quarter. And Elevation did not change because it's also based on the most recent equity round. So in total, that gets us to the $1.2 million write-up.
This is a great chart, Tyler. I'd love it. This goes back to Lauren. She wanted us to do this, and see where the changes in portfolio company values coming from is really helpful. Any questions for Tyler on this?
So this is just a prettier version of looking at the valuations quarter over quarter. But the main things that jump out are the large increase in Ninth Decimal of 1.3 million. Signal increased mostly due to the $500,000 follow on, and then Chartbeat's 300,000 decline. So looking at the 2020 financial forecast, this one's a little bigger than the Fund 3 and 4 since there's much more activity. But starting in the Q3 actual income statement, total investment income decreased from 2.4 in the prior quarter down to 2.2. I think this is a trend that will continue to come as some of our debt investments get sold off. So Storyblocks have been sold in Q2, and then in Q3 our Ninth Decimal debt converted to equity. So those are two interest payments that we're no longer getting. And then, as David mentioned, Elevation's debt likely is to be refinanced this week, and going forward we're going to continue to see that declining investment income. On the expenses side, we should also start seeing decreases due to management fees will decline as investments decrease, as well as we pay off SBA leverage, the interest around the SBA leverage will decline. But this quarter, the 249,000 that's highlighted, we did have a big increase in amortization, and this is the amortization of the SBA debentures. And so since we paid off 7.9 million of SBA debentures, we amortized the fees over the life of the debenture, and these are 10-year debentures. So we had to accelerate the amortization on the portions we paid off. So the expenses are bigger there, but going forward, in any quarter that we don't pay off SBA leverage, the amortization expenses should be lower. So in total, expenses came in at 1.1 million. So the net ordinary income also comes in at 1.1 million. We had a $50,000 realized loss, which was the write-off of the KEEP receivables that we no longer think we will collect. And we had net appreciation on investments of 725,000 for a total increase in partners capital of 1.8 million.
Tyler, you might just, as a reminder, what this 725 is different from the $1.2 million because of original issue discount.
Yeah, so the original issue discount up in investment income, the way we have to treat it for accounting purposes is it amortizes over the life of our debentures. And so as the original issue discount income gets recognized, the 561,000, the same amount gets taken out of our unrealized gain. So that is why the 725 is different from the 1.2 on the prior slide.
Yeah, thank you.
So on the balance sheet right below for September 30, our total investments came in at 96 million. We had a very small cash position and some accrued interest receivables from our portfolio companies at the end of the quarter for total assets of 96.6 million. On the liabilities side, we have SBA interest owed of 153,000, deferred interest income of 358,000, and we had a small balance on the line of credit of 50,000 at the end of the quarter. And this is the first quarter where this was the quarter where our SBA repayment came in. So SBA leverage decreased from 65.6 down to 57. And down at the bottom, our total partners capital increased by 1.7 million to 39.7. So looking at the year in total on the last column, we're forecasting $9 million of net investment income. We're forecasting total expenses of 4 million, which will bring our net ordinary income to around 5 million. We have realized gains of 3.8 million, and that is roughly 2.8 million of the Storyblocks realized gain from Q2. And then in Q4, we're forecasting the Elevation debt payoff. So we'll have a realized gain of around $1 million on that, which brings to the 3.8. $10 million depreciation of investments. As David's mentioned earlier, a lot of that comes from Q1 when we wrote down net decimal significantly. And so the total change in partners capital is a decrease of 1.3. On the balance sheet, we will end the year with 91 million of total investments, 6 million of cash. The large cash balance is going to come from the Elevation note repayment in the next few days. And from a liabilities perspective, the big change of the year is the SBA leverage being paid down. And so we're forecasting to end the year with total partners capital of 40.5 million.
You want to just explain the trend on the capital impairment?
Yeah, so the capital impairment, the line in orange at the bottom. So it was 31% at the beginning of the year. The liquidation of Storyblocks improved it greatly, down to 22 at the end of Q2. In Q3, you can see it jump back up to 31. This is SBA accounting. So although ninth decimal had an increase for GAAP purposes, the way we have to treat the structure of the ninth decimal deal for capital impairment purposes is we don't get any of the credit for our 2x liquidation or our 1.5x liquidation that we have in our different ninth decimal shares. But because our lowest shares of ninth decimal are out of the money, we have to show them as losses. So we're not getting any credit for our write-ups of essentially, I'm trying to remember what they were, around, I think 5 million or so on our other shares, but we do have to take the loss of our A3 shares. So for GAAP purposes, the ninth decimal transaction was great. And for going forward forecasting and exit scenarios, I think it was a great event for us. But for the SBA capital impairment purposes, it was not the greatest event, just because of their funky accounting. But we are forecasting with the elevation realized event to be back below 30 by the end of the year. And looking at 2021, there's a number of big events that drive this forecast. One of them is we're forecasting Boost to repay their debt in the first quarter, which will prompt a realized gain on the debt. We are forecasting a full Chartbeat exit in Q4 that will be around $8 million. We're forecasting a $8 million SBA leverage pay down in the first quarter. So leverage will go from 57.7 down to 49.7 million. We're forecasting a $780,000 tax distribution in Q1 to LPs. And the last major event is the $3 million follow-on in Wasabi. And in that $3 million follow-on, we are forecasting writing up the rest of our investment because that round's likely to be led by a significant new outside investor, which would prompt write-ups, whereas the most recent round was all invested in by current investors. So that's why we had not written up that round. And so on the year, we're forecasting $6 million of net investment income. Is a number of debt investments have paid off, or we're forecasting to pay off. The net investment income goes down significantly. We're forecasting total expenses to be $3.2 million, which is an $800,000 decrease from 2020. We're forecasting that'll leave net ordinary income at 2.8 million. And due to the Chartbeat and Boost liquidation events, we're forecasting 1.3 of realized gain and a $3.4 million appreciation of investments. So the total change in partners' capital will be 7.6. And on the balance sheet at the end of the year, we're forecasting 87.8 million of total investments, 8 million of cash, and that's due to the Chartbeat exit late in the year. For total investments of 96.7, and SBA leverage will be, as we mentioned, down to 49.7. And so partners' capital will be left with 47.4 million, which is a $6.8 million increase. And as David pointed to on the last forecast, the 2021 capital impairment gets materially better in 2021 as we are able to take some of the gains or write-ups on Wasabi, as well as have a couple more positive liquidations.
Great. Any questions? Tyler's been doing a fantastic job, by the way, of getting his arms around the whole financial function here and these forecasts. So we couldn't be more pleased. Any questions?
Sounds like he's gotten his arms around it, not getting, David.
Yeah, I'd say that. I don't want to praise him too much in front of
All right, I'll do it.
it.
Less relevant coming from me.
Well, it's definitely due to be recognized. So, so this life of funds forecast is a little bit more interesting, perhaps, because the earlier ones we just had one more year left. We were forecasting funds 3 and 4 winding up next year. This is more interesting. So what's important here is this is down here. This is our forecast. Mark and I reforecast each company every quarter for this schedule. What we expect to get in terms of proceeds and what year. And then that drives the upper section, which is what's the gross portfolio return profile, what does SBA get, and then what do our limited partners get. Because all of these deals other than Wasabi are sub-debt with warrant deals where most of the return is going to be return of principal or return of preference in the last most senior round of equity. These numbers are surprisingly consistent in terms of dollars every time we do a reforecast. For instance, I'm just going to pick Signal out. This $18 million proceeds from Signal, we will get that in any, do you remember, Tyler, it's any value from like $20 million to like $200 million.
Yeah, I think after their debt is, the senior debt's paid off, then any value that's like, I think it might be 25 or 30 through around, I think it's 300 or more.
Yeah.
We get that same $18 million and our return does not change at all. And then eventually we would convert to common shares and
at a higher value, but that's an extreme case. So some of these are a little bit more variable, but the important point to make on all of these is that there's not a lot of downside and there's not that much upside in these numbers. The real issue is when do they happen in terms of IRR. The real driver here is Wasabi. That's all equity, so it's very variable, and we don't know when it's going to happen either. We pushed it out to 2024. But if things happen in this scenario, as you can see, 2020, the year we're in elevation, that's going to happen. As we said, this is just the debt repayment. We've actually left in the equity piece here at $3 million out in 2023. And Storyblocks is already in there, and Keep. And then as we've talked about, Boost in 2021, we expect to get that debt part repaid, and we're forecasting Chartbeat to be liquidated completely. And then the others kind of follow in 2022 and 2023, and then Wasabi in 2024. So these, and then down here, interest income, this is how much we get from the debt securities we hold. You know, this all comes up here and populates these numbers and waterfalls down. And as we said earlier, we've made quite a leap in terms of what we're projecting for our LP net return to the LPs in terms of multiple and IRR up above 3.0, 3x, and north of 17% IRR. The changes will continue to be driven mostly by Wasabi or by changing in the timing of when exits happen in our other companies.
David, a couple of questions before you scoot off that.
Yeah.
One is just from a big picture perspective, you've already pointed out that the variability on Wasabi can move this thing around.
Yeah.
It's probably worth, and whether you consider it a true downside view, but if you zeroed out Wasabi, they had just a catastrophic event. How does that change your IRR if they're out? And not that you need to do it here, but it's understanding that that's the degree of variability it's introducing to the downside, but also, you know, you get a sense of, and again, I think you guys generally are pretty thoughtful about how you go about doing this, but it's another view of just saying, hey, we stepped a little out of the box by doing a whole equity piece. Here's what it is potentially doing for us. But even if you exclude it, we look like the following. That might be interesting, particularly, you know, if you do any of this for your annual meeting work at all.
Yep.
The other point I've got is it's just more of I couldn't quite tie out. Your yellow total is 219, 383. It doesn't match the 229, 895 at the bottom.
Right, that's
the
because
place,
the 229 includes the current income.
Yeah,
thinking.
but
Is that right?
every column matches except for
Oh,
the
you're right.
2017.
Yep.
So I think there's just something in the through 2017 that if you
Yeah.
make it match, there's a minus that's off.
Yeah.
It'll self-balance itself, but
Yeah,
something's off in there.
I can see what it is. It's the first, it's the number in the lower left. It's the 15.6.
Right. But
think that needs-
somewhere in your negatives is an equal offsetting amount for the $10 million difference.
Yep, that's a good catch.
But it's not, I think anyway, it doesn't have a ripple effect other than that beginning and ending column is going to have a couple of numbers tweak a little bit.
Yeah, I think this 5,106 should be 15,657. But we'll
Right,
correct that.
but then there's an offsetting difference somewhere in there for that 10 million and change.
Yeah, thank you. We will take a look at that.
I mean, obviously the three times multiple and 17 and a half IRR is eye popping. So don't take what I'm suggesting as saying that Wasabi will be worthless. It's just perhaps has some utility to say, if it weren't in there, this is what we considerably more conservatively look like.
Yeah.
But here's the benefit of stepping out on that diving board a little bit.
Yeah. We're trying to be really sensitive, Bruce, about not overstating Wasabi because of that.
And this is one way to get hyper sensitive is just pull it out and what do you look like?
Yeah.
That's unrealistic, but it gives you a lower end bookend, if you will, to consider.
Yeah. Well, we basically. Yeah.
I quickly just pulled it out, David, just to see what it comes in at, and without double checking all the formulas to make sure I didn't blow anything up, taking that zeroing out Wasabi. I think the formulas are still all working, but it looks like 1.47 and 6.4 for the LPs if you have Wasabi at 0.
Great. But it's a thank you, Tyler. That's really helpful. And maybe
thank you.
Next quarter, because it is the big variable, we might have a little schedule at the next board meeting that shows what it'd be easy to do, what the fund looks like at various.
It's kind of like what you're doing with Lumira.
Yeah.
In many respects, it's just that's a bit simpler in the sense that there is true unknown qualities, but there is a nice upward slope, and this is a ways out, but it's helpful to just provide some gradation to it.
Yeah. I mean, my view is if IBM, Oracle, Dell, or somebody like that doesn't come along and buy Wasabi for, a bigger number, they're missing a huge opportunity.
Agreed.
But, that's up to them, not to us. So but thank you for those comments. And anybody else that wants to chime in here. So you can see what's happened we'll now do this in chart form. Before we had just done it in numbers, and we'll continue to do this. This is the same chart we had for the other funds, but with less history because we don't start doing this till the fund is fully invested. But this is, a lot of this is Wasabi. Some of it is the 9th decimal transaction. And I think we're going to continue to, well, we will see. I don't want to forecast, but we're feeling good about the fund right now. Any questions on the life of funds before we move to one of our favorite topics, SBA? Okay. I forget, Mark or Tyler, who's gonna do this?
I can take it if you want, Mark. Okay. So as far as capital impairment goes, we kind of discussed it on the forecast slides, but capital impairment was 31.2% at the beginning of the year. It decreased with the Storyblocks realized event and then increased as a result of the in-market 9th decimal transaction. We're forecasting the year to be back below 30 though. Mark and David had reached out to Dan. I forget if it was around the Storyblocks sale or with the 9th decimal sale, but mentioned that we were expecting capital impairment to potentially go back up, but that it had gone down. And Dan's our SBA analyst. I think he's come to a few of the annual meetings and stuff, so you guys may remember him. but he responded back. This was when I think a lot of other portfolios maybe were getting hit hard with COVID, but told us that for the time being, you're no longer on our radar screen, which was nice to hear because for a little while there, we were sending them additional reporting. As far as exams go, Fund 4 and Fund 5 exams have been completed through 9/30/19. We had no findings on the Fund 5 exam. And for Fund 4, they recently reached out and have started the 9/30/2020 exam. So we provided them with all the details, and they actually started working on their review of Fund 4 this Monday. So so far we've had minimal questions from them. So hopefully that exam's gonna go smoothly.
Great. So that's what we have for Fund 4, Fund 5. Happy to answer any of those questions anybody might have. Okay. Fund 6.
The Fund 6, just a refresher on where we are at a really big picture level. Gone through the SBA green light process, and we got our green light letter, which gave us permission to start fundraising back in August of 2019. There's a minimum that we had to raise 60 million for first closing. We've gotten some indication since then that that minimum maybe there may be some flexibility in that. It could be 50 or 60 million, but 60 million is sort of the stated number. But the green light letter is only valid for 18 months. We were hoping to have closed by now, needless to say, but we have not. And that green light letter does expire at the beginning of March. So as I said, the fundraising process slowed with COVID, and a number of the banks, a lot of the banks, a couple of our bigger ones had a more of a material impact on us with KeyBank and Santander. But a number of the banks said, hold on, we need to wait and see what's happening in 2020 with the pandemic and how things play out in 2021. Still really like you guys, still really interested in investing, but we don't want to do any more SBIC investing until 2021. So that certainly slowed things down, but over that time, we've really ramped up the conversations with Stifel, which David's told you a little bit about, and I can give you a little bit more detail on now. There you go. Cue the slide. So on Stifel, as David mentioned, so it's, as a corporate entity, the Stifel corporate has two different divisions. There is a commercial bank and an investment bank, and they're working in partnership on this deal, which is part of what has taken as long as it has taken. The commercial bank has the board. It's actually the board of the entire entity has approved for the commercial bank a $20 million commitment to Fund 6. And then on the investment bank side, which is where most of our interaction has actually been, we actually have only met a couple of folks on the commercial bank, but the investment bank has been working on this term sheet of, as David said, sort of an acqui-hire of the North Atlantic brand and the team. And we're tentatively targeting to close at the beginning of the year. We'll see if that still plays out. It seems like it should be reasonable, but we're waiting for the next turn of the term sheet any moment, any day now. But the general contemplation here is that the North Atlantic that you all know and love is not included in the acquisition. It's possible, probable that we may have to do a name change or something to that entity, but that entity will stay in place. And that entity will continue to manage Fund 3, 4, and 5. Meanwhile, Stifel will create a new management company, and that new management company will raise and manage Fund 6 and any future North Atlantic funds. And that new company owned by Stifel will hire the North Atlantic team. We'll still be able to continue to work on Funds 3, 4, and 5 just as we are now. And the Fund 6 that the new North Atlantic will raise will be the same Fund 6 that we've been talking about, with the size and the strategy. The unleveraged SBIC fund will all be the same, but we'll just have a $20 million commitment from Stifel, and the management company will be owned by Stifel, but it will be the same people you see here, plus probably one or two additional folks from Stifel, at both the kind of helping us with deal sourcing and potentially at the partner level. As David said, we're really excited about it. Stifel seems to be quite excited about it. It's a great opportunity for them to leverage the North Atlantic brand and the structure and our team and our SBA relationships and all that has been built here over several decades. But then at the same time, allow us to leverage their brand and their relationships, particularly as it relates to fundraising, and also deal flow, since they have a lot of companies that are in our, or they work with and see a lot of companies that are in our potential target area. In addition to figuring out the term sheet, we've got to go through, we're figuring out what we have to do for SBA approvals. We may need to reapply for the Fund 6 with the new management company and with Stifel's involvement. We don't think that should be a major issue, given that it'll still be the same group of us, but now just with the addition of even more stability and capital and all, which the SBA tends to like. So we'll see on that exactly what we need to do. And then we'll be targeting a first closing, I mean, essentially as soon as we can, but it'll probably be dependent on the SBA and obviously the commitments from other LPs, but it's probably in the second quarter when that happens. We'd like to be able to ideally file before that March 6th, have commitments to be able to file before March 6th, but that's looking pretty optimistic and probably unrealistic at this point.
Hey, Mark, how close are you to the 60 million with Stifel's 20 now in there?
So it depends on how you measure it. But in terms of like hard commitments, we're not that close because, and we're in some ways, we're even less close. I think we would probably say with this change, the only real commitment that we have is Stifel. We have some other commitments, folks who have signed commitment letters, but this is a pretty big change and quite a bit of time has gone past. So, Bangor and Gorham and others have signed commitment letters. I think we would expect to go back to them and say, this is a big change. We'd still love to have you, but we want to make sure that this works for you.
Sure, but if you made the leap that 100% of that rolled, how close are you with including the 20 plus what you had for hard commitments?
So with hard commitments, it's still less than 30 million. With the 20 million from Stifel, we think with individuals it would get a bit higher, and then there's a number of folks of other banks, existing bank investors, who would be in the $5 to $10 million each range, who have all been we're interested, we think we want to do this, but let's wait category.
Meaning they're the 2021 decision makers.
Yep. Yeah. And there's multiple of those that are out there, but we're not there yet, with what we have in hand today.
Does Stifel get different terms for being the anchor, if you will, at 20 million?
Yes, but that's part of what has to be negotiated in the term sheet, and they may be able to get what they want since they own the management company without actually having that LP commitment get different terms, but they can get it out of the management company. But one way or another, yes, they will get favorable terms for that.
One of the things they've talked about, which is creative, see how it works out, is that actually having part of the carried interest and using that as currency within Stifel to incent the various activities within Stifel to work with us, send us deals, primarily deal flow. So they're thinking that we're not just going to sit there on our own and do what we've been doing. They actually want us to integrate with their other activities, like their venture lending group, and they want their venture lending group to send us deals because they're seeing a lot of companies that fit our profile, and that they would incent that activity by having some carried interest that they could share.
Will you own any part of the new co?
The management company, we will not own any part of it. We will be just employees of that. We will be owners of the general partner of the new funds.
And making capital contributions.
Any other
So,
questions on
yeah.
on that, particularly on the Stifel and then more broadly, but reactions, thoughts?
And changes, you mentioned individuals. Do you anticipate changes to the minimum that might affect your existing individuals who have either hard or soft commitments? You don't have a lot of individuals, but you have had some folks, whether they're former CEOs or former local, or not former, but local investors who've participated in your funds in the past.
Most of the individuals we had not specifically gone to yet because they tend to make relatively quick decisions. They're aware that we are going to be raising this next fund, but we hadn't sought commitments from them yet because we weren't at the point yet where their incremental difference was going to get us there.
Sure.
And so it tends to be easier to go to them at the end rather than looking for the commitments up front. We think most of them will still be interested, but to be determined.
But has Stifel expressed any change in your fund minimum, and what was that fund minimum previously?
They haven't, and it's I think it's a $500,000 minimum for new investors, which we've occasionally waived to $250 for either existing investors or in special circumstances, but it's typically been $500,000 for individuals.
Thanks.
Yeah, it's going to be interesting to see how effective. I mean, they really want to help us raise the money. They have relationships with banks. They have relationships with wealth managers. They're a wealth, yeah. So they have they touch a lot of money where their brand is going to be on this. Obviously, they don't want to screw it up. And I actually think the fact that this has taken about a year to develop, we've had lots of conversations and at pretty, the most recent conversations, most of them were actually basically the number 2 or 3 guy, the co-president of the whole institution. And we'd be reporting directly to that person. I mean, they're thinking of this strategically. I mean, one of the thoughts, and it's not really, they haven't developed it very well, but it really got this all started, was that they want to be the Silicon Valley Bank for the SBIC industry. So Silicon Valley Bank, as you may know, is the bank for the venture capital industry. And within the SBIC industry, there is no one bank that's kind of focused on the needs of that group of investors. And I wish Carl were on, but they actually were looking at buying a whole nother SBIC, more traditional investor. I think they were in New York, Mark.
Maybe Southern Connecticut, but
or Southern Connecticut. Yeah, it's in Carl's portfolio. We know who it is. We don't know them, but we know who it is. But that was what they were going to do, and then we kind of came along, and the more time went on, they apparently they haven't even talked to that group for a couple of months now, and we sort of risen up as the ones that can do this, and a lot of it actually has to do with just building really good personal relationships with the senior people within Stifel. I mean, they actually like us, believe it or not. We're kind of surprised they haven't done more personal reference checking. They've actually talked to a lot of our companies at our bequests, and so they see what we do. They know Boost, they know Wasabi, they have a relationship with Suzy. I mean, they know our companies, so they know what we do. they've gotten to know us, but they really haven't done the kind of personal reference checking that I kind of expected they might have done. But I think it's because we spent so much time with them. They've just gotten quite comfortable, and they've seen how we've progressed and our portfolios progressed through COVID. And they really see us as helping them create that strategy, is because we understand the SBIC world. They don't, but they do see it as a big opportunity. So part of this is they like us, they like our strategy, they want to make money, they want to introduce their clients. But part of it is as an institution, and this is why the $20 million that the board approved, that was a big event apparently at Stifel. They've never done anything like that before. And it took a lot of time and a lot of our, a lot of these two pieces, the bank, the commercial bank and the investment bank, spent a lot of time together. You can imagine the different cultures between the commercial bank, which is pretty traditional, mostly lending to mainstream. They have very good CRA apparently rating because they're very involved in the community. I mean, it's a really good, solid commercial bank. And then this investment bank, which is in New York, they're in St. Louis. And then they got the investment bank in New York, which is all, fee for service, transaction oriented, rah, 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 kind of pay, the pay scales are different. The culture is different. There was a lot of work that went into kind of getting both banks on board and saying, North Atlantic is going to be our, point on this. And, we don't think they're making a mistake. We like the people, but it's been a long process. I'm really excited personally to be, to hopefully help. And they've said they want the help, helping them with this grander strategy beyond, what we do and we do well as a money manager.
And in the course of your conversation with these folks, and again, looks like this is on track for January 1 by all of what you're indicating. I guess a couple thoughts, questions. You've targeted 60 to close, and you're looking at, my memory says you're looking at trying to get to 100 million, some of which would be done with line of credit leverage. How has that? No.
Go ahead, Mark.
Mark's shaking his head.
Right. Just so, the two different parts of the statement are not wrong, but together they're wrong.
Okay.
We would like to raise between 100 and 150 million. Ideally, we would like to have a line of credit, but it is not leverage on the fund that is additive to those numbers. It just allows for capital commitments to be delayed. Is how the line of credit would work. So we most likely would still do that, but it's not. But it doesn't add to those numbers.
Okay, thanks for the clarification, which also gets back to, in moving this direction, they're not suggesting pivoting back towards an SBA leverage structure. They're comfortable with what you just described, notwithstanding my muffing the description.
They are. It is something, over the many months that we've been talking to them, that I think was part of what they were getting their heads wrapped around, because the people who do understand SBIC funds were thinking about leverage and leveraged funds, and they'd worked with one group in particular that's a leveraged SBIC fund that converted into a BDC, and they helped them do that, and they got a bunch of fees and everything from that. So I think they were initially thinking, oh, we like North Atlantic, we'll do another deal with them where they get a bunch of leverage and then we go public as a BDC and everything. And that doesn't work if you're not a leveraged fund. So so they are comfortable with that now, but it was part of, I think, the getting to know us process.
Yeah. And I would think, with all of what you described about the holistic synergies here, that they would have the capacity of providing that line of credit for you folks. But again, you've got conflicts that have to be managed through that process. And maybe they want an arm's length, they want a third party to be in there, but they certainly have the I would think they've got the capacity to do a full line as opposed to trying to cobble something together through participation or otherwise.
Yes, I agree. They certainly seem like they do have the capacity. We've mentioned it to them over time with all of this. It's not something that they've kind of bid into as something that like, wow, yeah, well, that's a really important part of this. So, you know, I'd say still to be determined, and maybe once we're closed and we're working on that, then maybe they'll start to care.
Yeah, it's not necessarily a moneymaker for them. It's just a question of how convenient is it both to you and to them to have this be another part of sort of the a la carte options that you can leverage either easily, no pun intended on the leverage, but that you can dial into easily versus some other pieces that might be a bit heavier lift because it's reaching into their wealth management relationships, perhaps attract some high net worth individuals, or trying to get their help to cross-sell this into their broader mix of bank clients who are looking for SBIC investments of the nature of what you do, which you've established. It's a little bit different than a lot of other SBIC investments, not to mention other private capital firms.
Yep.
And just to put a point on that, Bruce, they could easily do it, but I think we mentioned this in the past, I don't know, but we have a proposal from Bridge Bank for a $40 million capital call line that they don't want to share with anybody. and it's part of their commitment to us. Now,
one's easier than more than one when it comes to those things.
Yeah, and we've mentioned that to them. We said, well, you know, we have this term sheet that Bridge Bank keeps pestering us, saying, when are you going to sign it? And we say, well, we're not ready. And it comes with a capital commitment to the fund as well. So we have that in place, and we were kind of surprised that they didn't say, no, you got to tell them no, it's going to be with us. They didn't do that. But I think that's part of the big SBIC strategy. They would want to do a lot of that for a lot of funds. So that has to be worked out. But as of right now, they're not. Mark's right. They're not saying, no, tell Bridge Bank to go away. You know, we want to do that.
Yep.
Oddly.
Good. No, great. I mean, everything that I'm hearing about it, I'm just judging by, you know, your reactions as much as anything, aside from reading it on paper. And it's different when you write in person, but at least two-dimensionally, you both look pretty pleased.
No, we're not there yet.
I understood, but you're T minus 30 days and counting. So
well, yeah, we've had a bunch of calls with this, you know, Victor, who's the number 3 guy in the whole institution, one-on-one. I mean, or, you know, Mark and I on him, just saying, you know, we have made the decision to do this, and we have a culture that when we make that kind of a decision, we do it. I mean, we're not, you know, we're down to negotiating compensation, and we do have to work out how do we maneuver through SBA. But the logic there is SBA knows us. They've already given us our green light for our 4th license, green light letter. We're not asking for leverage. With COVID and with the new administration, they're going to want to have SBA license as many funds as they possibly can, because they're trying to support the economy. Stifel is additive. I mean, there's nothing logical in the way of getting SBA to say yes, other than the fact that if there's going to be a 3rd general partner, they need to approve who that is. And with
it's a material change, but as you framed it, it's a materially enhancing change.
Yeah, but we've told them, you know, with the change of administration, getting an FBI background check in the 9 months is going to be damn near impossible, because everybody in Washington's changing jobs, and they all have to have FBI background checks. So, you know, there's some mechanical things we got to work on.
Sure. And you're dealing with the SBA.
Yeah, right. Unless there are any other questions, I have one more thing I'd like to do. Well, 2 more things. Any other sort of business questions? Okay. I want to thank what we call the Fab Four, which is the 4 here, the core team that's left over, managing through a year of unbelievable uncertainty, uncertainty about, you know, our future as an institution, uncertainty about COVID. I mean, Barbara, Tyler, Mark, thank you for hanging in there. You have been fantastic. It's helped to have a portfolio that's doing better. Barbara, I know, is excited, as am I, about not only the financial prospects for Alomira, but also for its, you know, its potential to make a major difference globally in world health. I mean, there's some things we have to be very, very thankful and grateful for, but I just want to say, I mean, Tyler has really just picked up, and Tyler's doing a better one person job than two before. You know, and everybody knows Mark. I mean, Mark's just, you know, you got to put up with him. But it's been a really, really, really good feeling here for me, I will say. And the prospect of doing something with Stiefel is I think is a testament. I mean, we're just four people sitting here in Portland, Maine, and they're really interested in us for whatever reason. But you know, there's a very good reason, and I think it's going to be really, next year is going to be an awful lot of fun. But sort of back to Mark, who's been here for 20 years, and we had hoped to do something recognizing Mark's 20 years at the annual meeting, but stores were closed and COVID was going on, and we were doing it virtually, so we never got around to it. But thanks to Barbara, good work here. And I'm in a different room, but Mark's going to finally get his Chelsea clock in recognition.
Oh, it's beautiful.
Of 20 years. It is gorgeous. And Barbara, thank you for doing all the logistical work. But Mark, congratulations on 20 and a half years, I guess. We will get it inscribed as 20 years, but it's a little late. Sorry for that. But thank you for being such an incredible partner, and for allowing us as an organization to get to this point with the portfolio, with Stiefel, with the team we've got, and the prospects for you know, building on that team next year. So thank you.
Thank you. I appreciate that. That's nice to be recognized. Thank you all. But you know, I wouldn't be here. All of us wouldn't be here without your leadership and everything you've brought North Atlantic through over 3+ decades is pretty amazing. So thank you.
Well, it's been fun and exciting. And thank you to the board for hanging in there with us as well. I think you're, you know, some of you may be on the board of this new fund. I hope. You know, we have to, that's one thing we haven't totally, I think they said that, you know, they would recognize a 9-member board representing the major investors that want to be part of it. So, but we will still be meeting, as Mark said.
Yeah.
We still have 3 funds to, I think we're going to have a lot of fun over the next couple of years.
Should be very interesting. And yeah, as to say, it will be a change for us in a number of ways, assuming that it does in fact happen. But a lot of these things, it should be, you know, we should still be able to do these meetings and still be managing these funds just as we have, and we may get some additional new faces.
Hopefully a dinner at 4th Street one of these days.
Make your reservations now for
Right.
for next December.
Indoor meeting at 4th
Right.
Street. Yeah. Well, thank you, everybody. I think we will have just an executive session, just because we always do. Just as a matter of course, I force this on all the boards I'm on, and I think it's just good practice. So Tyler and Barbara, if you wouldn't mind stepping out, thank you both for.
Happy holidays to you both. Thank you.
Thank you.
Good, and thank you all for hanging in and for the adjustment to the schedule today.